We think the setup is really constructive into next year for a broadening in earnings.
There's this element that maybe things could be better, and you have a lot of stimulus coming.
Let's not be complacent and just expect the same really positive performance we've seen so far this year.
If you start to see any kind of degradation in earnings, I would be much less optimistic.
The market tends to discount both good news and bad news fairly quickly.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
It's Fed Day. Good morning. Welcome to Bloomberg Surveillance. Stocks looking for direction, bonds finding some, and not in a good way. Yields surging globally, despite expectations for a rate cut at today's Fed meeting, with investors looking to the end of a worldwide easing cycle. And in the United States, economic data keeps showing a mixed picture with a wage inflation report due out today. We get that employment cost index ahead of the Fed meeting, and then Oracle earnings after the bell. All eyes right now very much on bonds, with yields climbing despite some of the assertions from both Fed officials as well as this administration.
And that makes a bit more of a difficult picture for the Fed. I've read about 4 different takes this morning on why yields are rising. Is it because what's going on in places like Japan, Australia, Canada, we have the end of some of these cycles or potentially some hikes in some of these countries? Is it because there is concern over the deficit? Think about things that are hanging over this economy, whether or not the Supreme Court tamps down on IEPA. Do we get $2,000 dividend checks from this administration in a midterm election year? They're concerned about affordability, and then that money goes out the door once again, and not to bring down the deficit. Or is it because investors are worried about the other mandate the Fed has to worry about, which is inflation? And right now the bias is on the labor market.
And that seems to be globally what is getting people a little bit concerned in terms of, have we already reached the peak of disinflation? And are we going to lead to the end of a global easing cycle? People pricing in the chances of a Bank of Japan hike, Australian rate hikes, ECB potentially not having any additional rate hikes. Just to put into perspective, the Federal Reserve has cut rates 175 basis points since it began the cycle back in September. A real question here, is this going to be an increasingly politically motivated Fed at a time where gold is surging and people are wondering, whither the dollar?
And also, this meeting particularly is very challenging. We have not had jobs or retail sales numbers for October and November. The Fed is still driving a bit in the fog right now. And Jay Powell is not a dove or a hawk at this meeting. He is a lame duck. And potentially, does it even matter how many dissents we get? And is it going to foreshadow how difficult the path is going to be for whoever the President of the United States puts in as his replacement?
I feel bad that the duck is the ultimate destination, given the fact that it could be a dove or a hawk. Right now, we also are heading into Oracle earnings at a time where that really is the key question. Can AI hopes and dreams continue to support this market? Right now, this market is not finding direction on the stock side. You're seeing pretty much across the board meandering between gains and losses, down about 0.1% for right now. Yields are finding a direction. 4.2% on the 10-year. Globally, 10-year yields at the highest levels going back to 2009 in the United States, the highest levels going back to September. They were at 4.07% at the last Fed meeting on October 29th. What we do see is a little bit of dollar weakness and crude prices rising. Coming up this hour, Julian Emanuel of Evercore ISI with stocks on hold ahead of that Fed rate decision. Erika Najarian of UBS as JP Morgan warns of higher costs ahead. And Nela Richardson of ADP on the state of the labor market as the data paints a mixed picture. We begin this hour with stocks little change as investors await the Fed's last rate decision of the year. Julian Emanuel of Evercore staying bullish into 2026, writing earnings strength, fiscal and monetary stimulus, and a capital market cycle moving into higher gear are laying the groundwork for 750 at year-end 2026. Julian, I am so glad to say, joins us here. Julian, thank you for being here.
Good morning.
So what do you make of the yields rising this morning?
Look, the first thing is we have to step back and understand something, that bond market cycles are very long-legged things, and the 40-year bond bull market ended at the pandemic lows in 2020. And when you think of an Annmarie, you just detailed all of the reasons that yields are going higher, and the answer is yes to every single one of them. You put it together, in our mind, if you think about it, it's almost remarkable that the confluence of the U.S. being the premier destination for capital has actually caused spreads against global bond markets to compress. You know, if you had said to me Japanese 10-year yields were going to be close to 2%, I would have told you at the beginning of the year that U.S. 10-year yields would be close to 5%, and we're not there. But all of these pressures are building in our mind towards higher yields.
If we do get a hawkish Fed today, is that going to diminish some of the optimism that you have heading into 2026 or support it, given the fact that the Fed is looking at a rosier economic backdrop?
So that is the question that is really fascinating in our mind. And we're a little bit uncomfortable by this, incredibly staunch consensus that we are going to get precisely a hawkish cut that is going to be bullish for stocks in the near term. We actually think long term it is bullish for stocks because simply it shows that the Fed is cognizant of the inflation problem as well. But the other issue there, Lisa, is the labor market is about as clear as mud. I think whatever, it's not even mud. It's unknowable right now. And that's really the aspect of the flying blind that is probably going to weigh on markets.
Julian, what unnerves you about the hawkish cut consensus? Is it the hawkish part, or is the fact that people think that is going to be bullish for stocks?
No, it's actually the deep consensus. So what we've seen this year, and our survey team has really been front foot on this, particularly during the government data blackout, is that anytime we've had really, really deep consensus, whether it was going back to that week in April where our clients, 81% of them, thought we were either in a recession or it was going to start in the second half, or going back to the end of October when a record 75% of our clients responded in our polling that the next 10% in the S&P 500 was up, and then you immediately had that 5% pullback. That's what bothers us, and the consensus around the fact that this is likely to be bullish. And frankly, if this was any other month than December, it probably would not be as sharp a consensus, but December tends to be a good month for stocks. We think there is potential for surprise here.
Like what? What's the surprise?
Well, look, if you look at last year, you had a hawkish cut at the December FOMC last year, and the market pulled back. It didn't derail the bull market in any way, shape, or form, but it made December an unexpectedly volatile month. And you add in the fact that you're going to get data, employment data, on the 16th. Who the heck ever heard of the Fed talking and then getting the data?
Agree.
It's ridiculous.
You're speaking Anne-Marie's language. She's saying,
Just
come on,
move
the meeting so we can actually get that data. It's not just the employment data. It's also a question around the big tech space and exactly what they are doing. I think about John Stoltzfus. He comes in every day singing, it's how you do the things you do. And it's sort of this question around Oracle, which reports earnings after the bell. How much are they, yes, planning for expansion, going to beat expectations, but continue building their debt pile in a way that seems not unsustainable, but potentially a little more precarious when it comes to capital markets?
Yeah, no, and actually from our point of view, the concern around the debt loads of these companies, this one in particular, is quite rational. If you think back to this whole talk about an AI bubble, which we don't believe we're anywhere near the end game yet at all in AI, but if you think back to the late 1990s, the concern was just random throwing money at everything, everywhere, without revenues. And in that respect, having a little bit of capital markets discipline around a company that is assuming a bigger debt load is very, very measured. And it shows that people are not losing their heads. But our question is that when those earnings are announced this afternoon, is it more the sense that the AI bubble is going to pop? We think it might actually be more the sense that the fear bubble, as reflected by the credit default swap market, may pop.
In other words, the idea that people are pricing in the highest chance of some sort of default or demanding the highest amount of compensation for default from the likes of Oracle going back to 2009, that might have to diminish. I do wonder the Fed's role, putting these two stories together. What is the Fed's role in lifting the AI bubble? This idea that if the Fed is overly easy, and I say overly based on the economic conditions, what they might warrant, does that lead to an inflation of some of these valuations and, frankly, the debt profiles of some of these companies that raises your concern?
It certainly could. And we have said for the last several months that given this sort of extraordinary time that we're in, where earnings are going to be good, the economy's humming along, even with the questions around labor, But the point is both monetary and fiscal stimulus really do have the potential. We've said there's a 30% chance that you get a full-on bubble next year, which we define as 9,000 in the S&P 500, which I think is also why, on balance, the Fed is trying to remind everyone of the dual mandate in general. But again, the questions around the labor market are very, very intense.
Especially given Joel's data came out yesterday and just added to this confusion, given the fact that the headlines number came in pretty well. And then you saw the quits number coming at the lowest pace going back to May of 2020. So choose your own adventure. Is gold telling us something? Because I was looking at the moves since the last Fed meeting. And what stands out to me, 10-year yields, 30-year yields, and gold up 7% in that period of time. Are we getting a signal there about the path of travel right now in terms of the U.S.'s role, in terms of fiscal dominance when it comes to the U.S. dollar, and when it comes to just going forward, what people think about this policy?
Well, gold has really the last couple of years been a portfolio diversifier. And then from our perspective, you saw what we believe is a reasonably significant dollar top in the first quarter of 2025. So gold tends to trade better on that. I would say, frankly, gold has actually lagged the last month or two as silver has shot the moon. That to us says that there's probably a pause in the precious metals frenzy coming, into 2026.
Yeah, silver prices surging. Julian Emanuel of Evercore, I'm so glad to say, is sticking with us. Yesterday, we were talking a lot about how President Trump allowed NVIDIA to sell the H200 chips into China, a reversal. The big question was, if we sell it, will they buy? And the answer is evidently yes. According to Reuters, ByteDance, Alibaba, both of them looking to order NVIDIA H200 chips after what we heard yesterday.
And the information said the government actually called in these companies, wanted to sit them down and ask them, what is the appetite? Do you need these chips? And I guess, according to Reuters, the answer was yes. Remember, the Financial Times said they were going to look at this, potentially have a lengthy process on who should be getting these chips. Because, of course, China, rather, they buy the homegrown champions. But it clearly shows that nothing is better right now than what the U.S. has in terms of advanced artificial intelligence semiconductors.
And some meetings taking place in China to discuss the extent of that connection coming up. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Good morning, Lisa. President Donald Trump holding a campaign-style rally in Pennsylvania last night. He told the crowd people are starting to see the benefits of tariffs as his administration tries to address affordability concerns. The president arguing that tariffs have allowed him to provide aid to farmers and force manufacturers to build plants and data centers in the U.S. Meanwhile, White House National Economic Council Director Kevin Hassett says he sees plenty of room to substantially lower rates. Hassett, who is seen as the front runner to replace Fed Chair Jay Powell, says if he becomes head of the Fed, his loyalty would be to his independent economic judgment, which he thinks the president trusts. And SpaceX is moving ahead with plans to go public next year. Sources telling us here at Bloomberg, Elon Musk's company aims to raise significantly more than $30 billion in its IPO. SpaceX is targeting a valuation of about $1.5 trillion, making it the biggest listing of all time if it happens. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, President Trump's economy.
Lower prices, bigger paychecks, inflation, we're crushing it. The only thing that's really going up big, it's called the stock market and your 401ks.
Bloomberg's Tyler Kendall and Anna Wong both joining us next from New York. This is Bloomberg Surveillance. Christmas tree inflation really on fire this year. It's one thing we were noticing. Question is everything else on fire too when it comes to the inflationary backdrop in markets, looking for direction in the equity space, still hovering near all-time highs and just pushing back from some of the lows in futures earlier this morning. A bit of dollar weakness as we look ahead to another Fed rate cut. That is the expectation, which would bring total rate cuts to 175 basis points since the beginning of the rate cutting cycle last September, and 10-year yields surging to the highest going back to the end of September, 4.2%. Back when the Fed last met, it was 4.07%, a 13 basis point increase since that last meeting. Silver surging to new all-time highs with another 0.7% gain this morning. Under surveillance this morning, President Trump's economy.
The new word is affordability. So they look at the camera and they say, this election is all about affordability. I have no higher priority than making America affordable again. Lower prices, bigger paychecks. $1.99 a gallon. How would you like to have $1.99? Inflation, we're crushing it. The only thing that's really going up big, it's called the stock market and your 401ks.
Here's the latest. President Trump promoting his economic agenda during a campaign-style speech in Pennsylvania, touting the success of tariffs and saying his administration is bringing down prices. We've got team coverage with Bloomberg's Tyler Kendall and Anna Wong, both in Washington, D.C. Tyler, I want to start with you. What was new that we heard yesterday? Was there any kind of shift in President Trump's tone?
Yeah. Hey, Lisa. Good morning. Well, this was really part of an administration-wide push to change the president's messaging when it comes to the economy, marking his first domestic policy address since Republicans were dealt a series of election losses last month. President Trump touted his policies, not necessarily anything new, but it was in this bid to address voter concerns around affordability as polls and data shows sagging sentiment. A new survey released this week by Fox News shows that 76% of American voters view the economy negatively. The president claimed people are starting to understand the benefits of his tariff policies, though did concede that he's gotten a lot of heat, in his words, over the tariff regime. At the same time, though, his aides are really trying to plead with the public that they need to have some patience here, even as we've seen new policies rolled out in recent weeks, everything from proposals of investigations into the food supply chain to actually issuing agricultural exemptions when it comes to certain tariffs. So we're going to have to see how this goes, because, Lisa, really, as we careen into the end of the year, it's going to be another affordability issue that is putting pressure on this White House, and that has to do with health care. As we careen into the end of the year, lawmakers are trying to grapple with that deadline for those expiring Affordable Care Act premium tax subsidies.
Yeah, and Tyler, this is a reason why people are having a hard time getting their hands around exactly what the inflationary pressures are. And Anna, I'd love your take on that, given the fact that the Fed feels like inflation is the lesser of the concerns between the jobs market and price stability. What are we seeing, whether it's the employment cost index that we get today at 8:30 or just in general, when it comes to surveys about just how much price pressure there actually is?
Lisa, so the short answer is not much right now. So the employment cost index that's coming out, it's likely to show that the employment cost is running about at 3.6% this year. So if you think that the labor productivity is running at about 2%, that means that, productivity adjusted wages is below 2%. So as Powell said, the labor market is not the source of inflation right now. Then we look at goods, which is how common people feel or gauge the price pressure and what this affordability debate is about. Well, so Chicago Fed President Austin Goolsbee runs a firm, or used to run a firm, that collect online prices. It's called the Adobe Price Index. And basically that index is showing that the November inflation for our goods actually declined by a lot compared to last year. And that's the same message we are seeing in our own collection of millions of online prices as well, that November was actually a very low inflation month. Now, being forward-looking, we also look at earning transcripts, which can predict inflation in 3 or 6 months, and that is showing very little inflation pressure in the next couple of quarters.
Thank you so much, Anna Wong and Bloomberg's Tyler Kendall. And I just mentioned Christmas trees, so I went to find out exactly what the Christmas tree inflation was. And it turns out that more people are buying fresh Christmas trees because the price of artificial ones have raised 10 to 15% due to tariffs on China. This according to the American Christmas Tree Association. So that's actually a real phenomenon.
And you can get a Christmas tree right outside your doorstep in New York. They're just on the street there.
Yeah, but they're you mean after Christmas and then celebrate Christmas in January. You can get it for free. Julian Emanuel of Evercore ISA still with us this morning. Julian, how are you looking at affordability issues when it comes to trying to position and understanding exactly which sectors could potentially outperform?
Sure. Well, let's take a step back and recognize how unusual this cycle is, right? Literally, consumer sentiment has been subdued or worse than subdued, essentially since the pandemic, without any let-up. That's totally unprecedented in an environment where we've never even had the threat of a recession, despite perceptions earlier this year. And so this whole concept of affordability sort of addresses the desire to boost sentiment and really, grapple with the concept that the consumer is feeling K-shaped. The economy is feeling K-shaped, and ultimately the flow-through has been the stock market has felt K-shaped. And from both the demand side, i.e., big, beautiful bill stimulus, potential tariff rebate checks, and then the supply side, reducing coffee tariffs, importing more beef from Argentina. The whole idea is to boost that sentiment. And from our point of view, we think it's a very unique opportunity to own the beaten down consumer names. There's just a lot of consumer names that have been left in the dust in both the staples world and the discretionary world, as people have, perhaps rightly so, concentrated on putting their money behind the AI theme. But we do think, and we've seen a lot of these sort of mid to lower end names report and have very positive price reactions the last number of weeks against the holiday season that's shaping up nicely. And then the last thing is that the tendency for these names, many of which are down in a bullish year, to outperform in the first quarter, the reversion trade, very strong. So we think the K gets addressed by policy and likely shows up in the stock market.
So does that mean you believe in a rotation?
It is part of the story. Look, again, when we think about 2026, this notion that the market can still travel higher without the AI trade leading, we're a bit skeptical about that, but think about it, is we had the government shutdown. Everyone recognized very quickly that they were A, underweight healthcare, and that B, healthcare was the central policy issue around the shutdown. And then we had this massive healthcare outperformance. We think we'll see the same thing in the consumer space.
We're already going to get fiscal juice when it comes to the one big beautiful bill. Now they're teasing out potentially $2,000 tariff dividend checks. This is the same group of people, Republicans, who then criticize the Biden administration for doing just that, sending out checks. Do you think this will also goose inflation? Doesn't that become a more difficult story then to tame for the consumer and for the Fed?
Well, look, if you're going to put more money in the system, you're going to underpin inflation. But I will say when we think about 2025 and thinking into 2026, look, we and most everyone else overestimated the impact on inflation from tariffs. Okay. And so as that continues to dissipate and make its way through the system, the likelihood is the path of travel for inflation does continue down, which again is why, when you think about the course of interest rates next year, there's no set of economic statistics where the Fed will end up hiking rates at all next year. And frankly, the market is very rationally priced for the number of cuts expected next year.
Yeah, watch the dot plot. Do we get the same kind of one cut next year and then one cut in 2027? Does it mean anything, given the fact we could get a real change on the Fed's leadership? Julian, Emanuel, always wonderful to see you. Good luck with all of the shopping on all holiday counts. Evercore ISI's main markets maven, who we love speaking to. Coming up, we're going to be speaking with Erika Najarian of UBS on the state of the financials, with JP Morgan shares falling by the most in 8 months. Plus, Danny Berger with your morning movers. GE Verona jumping after doubling its dividend. What we're seeing in markets more broadly is just a real kind of sense of malaise. I mean, what is exactly going to motivate anybody to take conviction right now ahead of this meeting?
No way, not ahead of the Fed meeting. And then even after the Fed meeting, there is still feels like one more week left of this year. And that's because we're going to get jobs data next week.
Exactly, which will definitely color things. Right now, we are seeing a real outperformance when it comes to silver ahead of those Oracle earnings. From New York, good morning. This is Bloomberg Surveillance. We are close to all-time highs, but not exactly finding direction this morning. Seeing stocks just come off a little bit, futures just touch lower, although they had been down significantly more earlier this morning. A focus on dollar weakness, although 116 is essentially where we were when the Fed last met on October 19th. Here we are again at 116.35. We have been snoozeville in the FX space. 10-year yields anything but. We see 1 basis point increase this morning to 420 on that 10-year. We had been at 4.07 in the last Fed meeting. A real question here about what is driving the global bond sell-off in longer duration notes. We see that across the board in silver, surging to new all-time highs, up 0.5% this morning to more than $60, 3 hours away from the cash open. Here are your morning movers with Danny Berger. Danny.
Hey, Lisa, it's earnings season for some of the big power players, and what an earnings season it is. It's really fueled by the AI boom and the positivity that these companies see to capitalize off of it. GE Vernovia is one of them. They've increased their buybacks, increased their dividend, increased the revenue that they see coming in. In fact, they say that the backlog for electrification for this power player is going to double by 2028. The reaction in share prices is one that you might expect. Shares up 9.4%. Elsewhere in terms of movers, we have a new deal between Palantir and the Navy. The Navy is going to be using some of their platform for their submarines. The deal worth about just under $450 million. So Palantir rallying 1.3% off the back of that in the pre-market. Finally, we had earnings from Cracker Barrel after the bell yesterday, still hurting, at least they say, from the drama over its logo change that changed and then didn't change because of pressure from the White House and other conservative commentators. The results were pretty poor. Their outlook, they're burning more cash than they expected. They're trying to cut back on expenses. Foot traffic fell 11% through this most recent quarter. The CEO saying that a recovery will take some time. Of course, it's not just the logo drama. It's also just the pain for a lot of these more kind of casual restaurants. So those shares down almost 8% in the pre-market, Lisa.
Thank you so much, Danny. All about the logo. Come on, and forget everything else. On our radar this morning, the race to replace Jay Powell heating up, according to multiple sources. President Donald Trump is interviewing Fed chair finalists this week. Wasn't he doing it last week? Well, the Financial Times saying Kevin Hassett remains the front runner. Meanwhile, Oracle set to report quarterly results after the closing bell. Investors looking for an update on the health of its cloud infrastructure business and proof that the future of AI computing is sustainable. And Chinese tech giants Alibaba and ByteDance reportedly eager to purchase NVIDIA's H200 chips. This is important. Reuters reporting the tech giants have spoken with NVIDIA following the reversal of the export restrictions. We heard that yesterday from President Trump. The information also reporting that Chinese officials held an emergency meeting with tech giants earlier to assess their chip demand. So will they, if we sell it, will they buy? The answer seems to be yes.
Yes, it is definitely yes from the C-suite of these companies like Alibaba. It seems like they're just waiting on that final green light from the Chinese government. Remember, the Chinese government told these firms to shrug off the H20 when the U.S. lifted that export control. That was the chip NVIDIA designed specifically to sell into China. China said, no, we want the top level. We heard Jensen Huang talk about this recently, saying China does not want a depreciated chip. They want the full advanced chip. And now it looks like they're going to get it, and the appetite is there.
Yeah, this is what people are tracking to understand the tit for tat in the battle for AI supremacy between the U.S. and China. Looking for the battle of supremacy in the media space, the battle for Warner Brothers Discovery showing no signs of letting up. The company not planning to cancel its agreement to merge with Netflix, putting the ball in Paramount's court as it weighs the next steps. Bloomberg's Geeta Raghunathan joins us now. It seems like this is truly going to be a battle with Paramount appealing directly to shareholders. How much do you expect them to increase the share price that they offer?
Yeah, I think they definitely have to sweeten their bid at this point, Lisa. So the $30 per all-cash bid that they offered for Warner Brothers Discovery, and this is for the entire company, this is something that they had submitted last week to the board, the Warner Brothers board, and the Warner Brothers board obviously had rejected that and gone for the Netflix offer, which is a slightly different offer. It's just for the streaming and the studio business. So everything really right now hinging on the cable network business, which Paramount values at about $1 a share. We think it's worth much higher. I think the Warner Brothers Discovery Board also thinks it's much higher. So as far as we are looking at it, we think that they have to at least sweeten their bid by $1 or $1.50 per share for it to really kind of move the needle with the Warner Brothers Discovery Board.
And just to put into perspective, Geetha, Warner Brothers has no incentive to cancel the agreement with Netflix because they would be on the hook then to pay a pretty hefty fee, correct?
They would have to pay $2.8 billion of a termination fee if they decide to cancel. And I don't think it makes sense for them right now because I think they also value the company slightly higher. That said, I mean, this is... At the end of the day, Lisa, I mean, Warner Brothers Discovery, David Zaslav really wants to see his assets bid up as much as possible. So, if we're looking something at like $34, $35 a share, I think that's where he wants this bidding war to, kind of end. So we'll have to wait and watch, see what happens.
Who doesn't want that? Geetha Ranganathan of Bloomberg Intelligence, thank you so much. Turning to financials, especially as we get this surge of deals, JP Morgan shares dropping by the most since April after warning of higher than expected costs. The bank saying compensation, marketing, and AI investments are driving up expenses. Erika Najarian of UBS has a buy rating on the stock, a price target of $357. And Erika joins us now in studio for more. Erika, wonderful to see you. Thank you for being here.
Good to see you.
Before we get into that, the idea of the emphasis on increasing costs, how much can that supersede the idea that we're embarking on an M&A boom that we were just talking about, as well as potentially a surge in IPOs?
It's a commoditized business, right? So there's actually nothing that JP Morgan does that's special versus peers other than execute, right? So the talent needed to close those deals, the investments needed to, be very competitive with American Express Platinum, with, Chase Sapphire Reserve, that all costs money. And, what JP Morgan has shown us really over the past 15 years is they've been the heaviest grower of expenses among the banks, but they've also had the best revenue growth and the best returns. So I'm not worried. I think this is a timing thing with JP Morgan, and they'll give us the revenue number in January. But I bet you that most of the banks next year, and we got some indication yesterday from a regional bank that said they were also growing expenses heavily next year. It's going to be a year of saying, we have deregulation, we have a good revenue backdrop, possibly a very steep yield curve. Why not invest for the future?
Well, this raises this issue of more broadly in markets. Are we seeing companies get penalized for spending on AI versus earlier this year when companies couldn't spend enough and they were rewarded for that investment with the expectation that it would bring efficiency and better execution? Is that something that's a momentary blip or something that you see lasting in the financial space?
I think it's a momentary blip, and I'll tell you why. We actually had a meeting, I think 4 weeks ago now, with the head of AI at JP Morgan. And what she said really opened my eyes. She said, guys, you're all asking me about ROI on AI investments, but what's the ROI on internet access? What's the ROI on having a PC? So what she was saying is that AI at the desktops or in terms of how, bankers go about their day is going to be table stakes for the industry. So I think it's a momentary blip, especially since a lot of investors seem keen on the idea, on the theme that AI could lower costs meaningfully for financials.
That's what I wanted to ask you. Wells Fargo CEO yesterday was talking about how artificial intelligence can actually be the reason to bring down costs. But when actually could we see that if right now you're hearing from the likes of JP Morgan that they're actually spending more?
Well, I think we're in the cycle where you're not really going to see it quite yet, and we don't quite know where it's going to be improved productivity or actual costs getting cut. Remember, we're in a regulated industry. And so, I doubt any of these banks will all of a sudden, cut 30% of their call centers and replace it with agentic AI, only to have the AI technology have a hallucination and all of a sudden, your grandmother is in structured credit and crypto, right? So
hallucination, but carry on.
Hallucination, yeah. Exactly. But my point is that it's a regulated industry, and I don't think the regulators are as advanced as the banks in understanding, and so they have to tread carefully. So while that's an opportunity for certain parts of the business over the long term, I think we're going to go through a period of you have to spend money to be able to, be at the top of your class with regards to having this technology for your employees.
You mentioned deregulation a few times.
Yeah.
How do you actually see the deregulation working in real time? What are you expecting in 2026 that maybe we didn't get from the Trump administration in 2025?
Yeah, so perfect example, because this was rooted in law with the Chevron case, the stress test had to change immediately. In fact, it was a Biden Fed that's, self-started this in December of 2024. So all the banks got great results in June, and all of a sudden, and again, part of this is the market demand as well. I mean, trading revenues just went off. Right. And there was actually more balance sheet driven trading revenues as well. So banks were, taking more risk. So that was the more immediate impact. On Friday, there was a leveraged lending limit that all of the federal agencies pulled. A lot of the regional banks have been saying that was been a big catalyst for lending from banks really going away to the non-banks, right? And so that being pulled will be, a big immediate impact for next year. And of course, you have all the capital, the leverage ratio, the G-SIB surcharge, you have all that on tap to be regulated. And what that really means is that there's more balance sheet for markets, but more importantly, more balance sheet for Main Street.
I'm thinking right now of a $59 billion bridge loan from Wells Fargo, BNP, and HSBC for the Netflix bid for Warner Brothers. I'm just wondering how much this expansion effectively of their balance sheet is going to help fuel what we're seeing in M&A and IPOs, with the pace really heating up and financing seemingly plentiful.
Market is near all-time highs. Spreads are at all-time tights. And, bank balance sheets, even before you redefine capital, they have plenty of room, right? They have been losing direct lending to non-banks for quite some time now, so they have plenty of room. And so I guess it sets up pretty well for, a pretty nice, I was going to say the word frothy, but who knows, for a frothy 2026. It's like giving, sugar to your kid, right? Maybe he'll stay awake for a while. I don't know how long the economy will stay awake for, but it makes sense. We have the midterm elections coming up. And I'm sure that this administration will put lipstick, contour on this economy to get it through the finish line, right? And the president started to talk about make affordability great again. So I think we're starting. He talked about the tariffs checks. So I think it's going to be, a big year for increasing demand for bank balance sheets.
I'm feeling the holiday evening, putting on makeup, giving the kid hot cocoa, seeing them go absolutely bonkers. But then they crash.
Exactly.
And that's exactly what I was going to say.
Yep.
That essentially you're building risk, you're building the frothiness, you're building the excitement, and they haven't taken a nap. So at what point do you get worried about the other side?
Look, I use the sugar analogy very precisely, right? I'm a mom. Look, I'm a little bit nervous. We have been pumping this economy, and obviously we're seeing a little bit of, fraying at the seams. The unemployment picture is not fully bright, right? We have, white collar layoffs that you guys have announced at various points over the past quarter. You have a real struggle with university graduates finding jobs. And of course, you have, government jobs being reduced. So, again, we could put the lipstick and the contour and the Band-Aid in the economy, but underneath the surface, what's going to happen? And with, the tariff policy, right, the consumers aren't feeling it. But if you have thinner margins at companies, that means that, that's not going to be great for hiring. And, credit quality is going to be the end all be all in bank stocks, right? So everything is fine in 2026, but is there a nap? Is there a crash that's going to happen in 2027? Let's see. And it's going to be very important who we have in the Fed at the Fed in terms of policy and credibility with the bond market.
Erika, thank you so much for being with us. Wonderful to have you, as always.
Thank you.
Erika Najarian of UBS, and good luck in the holiday celebration. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. Oaktree Capital co-founder Howard Marks says AI has created a terrifying outlook for employment. He warns that the assumed productivity boom from AI fails to consider how many people will be able to afford the additional goods produced. Meanwhile, Amazon making a big investment in India, the company pledging to invest $35 billion in the country over the next 5 years. In a statement, Amazon saying it will invest in areas such as AI and logistics infrastructure, helping create an additional 1 million jobs in India. And Australia begins a ban on social media today for anyone under 16. Platforms are facing hefty fines if they fail to block young users. TikTok, Instagram, Snapchat, YouTube, and Reddit say they will comply despite opposing the rules. Policymakers in countries including Indonesia, Denmark, and Brazil are weighing similar measures. That's Bloomberg Brief. Lisa?
Thank you so much, Yahira. I thought this was fascinating. I am actually really looking forward to see exactly how effective this is, although I heard that Discord downloads actually just went off the hook for people who are preparing for their summer vacation out in Australia.
Well, when it comes to what social security concerns for teens that are dealing with things like TikTok, you're seeing this on a state level, actually a lot more pressure, especially from parents, putting on the legislator or governors to do something about it.
Yeah, definitely something front and focus. Meanwhile, talking about the Federal Reserve up next, balancing the dual mandate.
Central banks are getting to the end of their cutting cycles. From here, it's going to take further weakness in the labor market to get them to move a lot more.
Nela Richardson of ADP joins us next as we take a look at the labor market. Globally, you're seeing bond yields surging to the highest levels going back to 2009 in the United States. 10-year yields at 4.2%. This is Bloomberg Surveillance. Kind of meandering around. It was a Santa Claus rally that just got stalled out ahead of the Fed meeting. Right now, really seeing just a touch of losses across the board. S&P futures lower by 0.1%. NASDAQ underperforming, down 0.2% in pre-market trading. If you take a look at 2s, 10s, and 30s, the action has been and continues to be at the long end of the yield curve. That's where you're continuing to see a sell-off on the price, an increase in the yields with 10-year yields at 4.20, 30-year yields at 4.81%. The 2-year yield back on October 29th, when the Fed last met, was 3.6%. Guess where it is right now? 3.62%. Has not moved. It has been a yield curve steepening ahead of this central bank meeting. Under surveillance this morning, balancing the dual mandate.
The U.S. labor market is soft right now, relatively weak, you might even say. Our view is that as you move through 2026, it looks stable, resilient, even improves as it goes along, and that's what's going to determine the Fed cutting path. From here, it's going to take further weakness in the labor market to get them to move a lot more. Central banks are getting to the end of their cutting cycles, so that's something that investors have to really make a big call on for 2026.
Here's the latest. Investors weighing mixed signals from the labor market as policymakers gear up for the final Fed rate decision of the year. Nela Richardson of ADP highlighting the warning signs coming from small businesses, writing small employers historically have been a bellwether for the macro economy. The pullback in small business hiring has led to large losses for the labor market as a whole. Nela joins us now. And Nela, wonderful to speak with you, especially given the lack of clarity everywhere else. Yesterday's JOLTS data was a mystery wrapped in a riddle, depending on which angle you looked at it. Why are you taking such a signal from small businesses?
Because they're the engine of growth for the economy. I mean, if you look at the very smallest firms, 4 in 10 workers, U.S. workers, work in those firms, and those are firms with under 50 employees. And if you even go up to 250, you have 3/4 of U.S. employees working at those firms. So we watch the headlines from the big companies, but the hiring comes from the small ones. And they're more vulnerable to macroeconomic conditions, whether they're to the downside or to the upside. So these are the firms that are going to signal progress. It's the small firms. When they start hiring broadly, that's when we know that the labor market is not only resilient, but dynamic, which is what we need for an AI future.
Nela, is the small business indication that you're seeing in markets right now a forward-looking indicator, a backward-looking indicator, or a coincident indicator, given the fact that people are looking for visibility not to the end of this year, but into 2026?
Yeah, so market small firms and small cap is a little different than the mom and pop stores that we were tracking in terms of the labor market. I think what we're seeing in the markets is a very strong upward movement led by tech firms. But for the small firms that I'm talking about, the ones that you buy like your paper towels from at the bodega in New York City, they're not represented in the markets. And that's why it's so important to keep a mindful eye towards the hiring rate. If you look at that JOLTS report, there was a lot of attention to job openings. My eye was laser focused on the hiring rate, which stepped down from September to October. And Lisa, this is where the metal meets the road, because it's not just about 1 month. It's about the frequency of pullbacks on Main Street whenever they feel some turbulence on the macro side.
When it comes to those small businesses, could a likely Fed rate cut today help?
It could help. It's not going to help immediately. It could help because small firms get their financing from banks. And so rate cuts lead to loans that are cheaper, which means that they can expand their companies and their hiring count. But that doesn't happen overnight. It doesn't happen in a month. It doesn't even really happen in a quarter. And so if you take a long-term view on those rate cuts, they do hit Main Street, but with a lag, long and variable.
You also mentioned the JOLTS data. October job openings, I know, did get a lot of fanfare, but it's because it increased the highest level in 5 months. That is good news. Where exactly are those openings?
Yeah, we're seeing some good news actually as well in our weekly NER Pulse report that we released yesterday. We saw an uptick in hiring for the week ending November 22nd. So it rhymes with some of the better news in terms of job openings. But if you look at where hiring has been strong, even for small firms, actually only for small firms, it's been in healthcare. That has been the key to unlocking the labor market. And I would expect overall, even with the JOLTS signal, that healthcare would be the industry that will be doing the lion's share of the work for the labor market.
Nela, I know that you've been doing some work with some Stanford researchers on artificial intelligence and the ramifications for the labor market. Howard Marks, in a memo yesterday, came out and said that artificial intelligence was terrifying for the labor market in terms of some of the destructive capabilities, removing the need for certain jobs. Are you seeing that increasingly used as an excuse? We always kind of take your temperature on this, but what's the latest on that front?
Yeah, we've seen some AI impact on early career. Stanford researchers, the Stanford Digital Economy Lab, looked at ADP data and they were able to slice it by demographics. And you're seeing a slowdown in AI-exposed occupations like software developers when it comes to young college graduates, the 22 to 25-year-old range, but not for tenured workers. And I think that's very important to keep in mind. Look, technology, automation, and displacement is not new. It happens with every productivity cycle. What could be new for AI is making mediocre performers great and making great performers thrive and excellent. And that's kind of what the data is suggesting right now. Even this early data, it is increasing employment for tenured workers. And other research that Stanford has done shows that in an increase of low performers to higher performing standards. So we're still in the early part of this boom. And if AI fulfills its promise, it's not just going to automate, it's going to create. And it's going to create something new, unique, and different than what human creators can do.
Love the optimism. Nela Richardson of ADP, thank you so much for being with us on this pre-Fed morning. And really, this is going to be the focus, right? How much is structural? How much is cyclical? Are we seeing lagging indications of weakness? Or is this something more pernicious as we change in terms of technological leadership?
And I'm really glad you brought up that Howard Marks blog post, because he talked about these promises that potentially some billionaires on coast having all this money, making this technology that puts millions out of work. And what does that mean politically? I already think we're seeing that. And that is why we continuously be in this populist wave. And how does the Fed address AI-induced labor cuts? You can't.
Right, which is something that they've talked about in terms of, do you see at least an increase in productivity? Coming up next, Chris Harvey in his new seat at CIBC, Sarah Bianchi of Evercore ISI, Lindsey Piegza of Stifel, and Tony Rodriguez of Nuveen as we await that Fed meeting that concludes later today. This is Bloomberg Surveillance. Good morning.
We're in a process of normalization of interest rates.
We also anticipate further rate cuts in the coming year.
The market's been pretty anchored to sort of having the year-end target range kind of around 3% at the end of next year.
The rate cuts are baked in as far as the yield curve, shows you.
We don't think the Fed should be cutting rates at every meeting from now until next June.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance on this Fed day. Stocks looking for direction. Bonds have direction. They're going down. Yields surging globally despite expectations for a rate cut at today's Fed meeting, with investors looking to the end of a worldwide easing cycle. And in the United States, economic data keeps showing that mixed picture, the mystery in the labor market. Wage inflation report due out today around 8:30 a.m. Oracle set to report earnings after the bell, with a real question about how much AI can keep bolstering expectations.
And one portfolio manager that owns Oracle says their neck is sticking out because when they announced this massive debt deal, their stock fell 33%. 3 months ago when they reported earnings, it was one of the best days they had. Shares absolutely ripping. Now everyone is concerned because there are still fears in the AI bubble and the fact that all of these companies are tapping the debt market, and then there's a lot of questions about the circular financing of all of it. You can have my chips, I will invest in your company. Doesn't make a lot of sense at this moment. 2026 is going to be huge for this trade.
Yeah, and this is a reason why I keep thinking of John Stoltzfus this morning, who comes in, the biggest bull on Wall Street, singing, "It's the way you do the things you do," because ultimately it is about the debt side of things. In the debt side of things, it really is bonds front and focus this morning ahead of that Fed meeting. Torsten Slok put out a note this morning from Apollo saying a mystery in fixed income. The bottom line is that the yield curve continues to steepen, and investors across all asset classes need to think about why, as we do see the biggest sell-off, yields rising on the 10-year denomination globally to the highest level since 2009.
And anytime I started talking about the deficit this morning or potentially other concerns about inflation, a lot of people are saying, no, this is a global problem. The United States may be done with the easing cycle today, or maybe just one cut next year. You have Japan preparing for a hike. You have to look at what's going on in Australia. The ECB is not hiking anymore. And this is just a global phenomenon, has nothing to do with what's going on in the United States. Time will tell.
Yeah, this is a reason why people are looking at the reaction to the Fed meeting that kicks off in terms of rate decision. We get that decision at 2 p.m. Eastern time. At 2:30 p.m., we get the lame duck coming out, Jerome Powell. Although, is he, right? This is really going to be the key question as he takes the helm of this press conference at 2:30 p.m. Eastern in Washington, D.C. How much clout does he still have on the Fed committee, given the fact that he has a good degree of respect at this point? And then after that, we get Oracle earnings. Get a sense and a read, as Annmarie was talking about, of just how much people are getting tired of the debt-fueled cycle. Coming up this hour, don't miss this. Chris Harvey of CIBC going risk on into the new year. Sarah Bianchi of Evercore as President Trump tests his affordability message. And Lindsey Piegza of Stifel as Fed Chair finalist Kevin Hassett pushes for a bigger rate cut. We begin this hour with stocks stable ahead of the Fed decision, as well as more tech earnings. Chris Harvey, head of equity and portfolio strategy at CIBC, writing, "We expect risk on into 2026 and do believe we see a 7 handle on the SPX before year end." Chris joins us now from his new seat for more. Chris, wonderful to see you. Thank you so much for being here.
It's good to be back.
Congratulations.
Thank you.
So let's just talk about heading into next year, the role of the Federal Reserve in this, because it is Fed Day. How much is it crucial that the Fed does keep easing at a time where there are increasing questions about the capacity to do so?
That's a tough question because we're in the transition, right? And so let's just talk about today. There's a lot of thought that this is going to be a hawkish cut, that Powell's going to come out, cut 25 basis points and throw water on the belief that we're going to have any more cuts. I'm not really sure, even if he does that, I'm not really sure the market believes that because the candidates that are coming in are a lot more dovish than that. So I think we walk through that. I think the market believes that we're going to have a dovish Fed, more accommodation in 2026. So I'm not too worried about things right here, right now. The other thing, I think Powell will probably go right down the middle. He'll say we're data driven, right? He's not gonna lean one way or the other. He'll just say we're data driven and leave it at that. So that's one of the reasons why I think in the short term we're still in a risk on type period. But in 2026. I think we're going to have a lot more flare-ups in risk. We'll have a lot more bouts of risk aversion. And 2026, or the first half of 26, it's really about risk mitigation and trying to keep up to keep up with the market, but really protect to the downside.
What risk mitigation is most necessary? The risk of overheating AI valuations or the risk of a U.S. economy showing some signs of strain?
Not so much about the U.S. economy. It's really the return to risk is exceptional this year. And it's right across the board. If you look at IG credit spreads, they're at, I think, 77 basis points. We haven't seen that coming into a new year since 2005. If you look at the return to risk, the S&P high beta index is up 33, 34%. And we expected that post-Liberation Day, but not 6 and 9 months later. And so what we think is the bid for risk has gone a little bit too far. And when we turn the calendar, what you're going to do is you're going to reset risk budgets. You're going to have a lot more concern about the Fed. You'll have perceptions about the economy go. And so as a result, we'll see more bouts of risk aversion. We'll see more spikes in volatility. But at the end of the day, we still think there's still upside to be had.
You say the wild card today is Oracle, and you're really watching that for risk.
Yep.
Is that going to paint the tone for the rest of this AI trade?
No, so it's funny you say that, because if you look, and there's been a lot of talk about the paper that's been sold, right? A lot of hyperscalers have issued paper, but if you look at Meta, Google, I think it was Amazon, all that paper is trading better than when it was issued. Oracle's off its wides, but still wide. And so what it's saying is Oracle's over here and other hyperscalers are over there. And so, yes, it's a wild card because it's such a big risk at this point in time and all eyes are focused on it. But if you look at the broader market, the broader hyperscaler market, it actually is performing pretty well. And the market's not that worried about it. It's more idiosyncratic.
So when you say there's going to be volatility in 2026, 2025 was all about policy uncertainty in Washington.
Yep.
What is 2026?
Well, I think the first thing, maybe I'll throw out a phrase, it's about the corporate collar, right? So at the beginning of the year, what do? You issue guidance. It's been a great year for a lot of stocks. A lot of stocks have done well. So what am I going to do? What makes sense? I'm going to manage expectations down. So that's one area where risk may come in. We're having a transition with the Fed. We don't really know how that transition is going to go. It's long. Usually the Fed transition is at the beginning of the year. This is not until May. Leaves a lot for interpretation. And then lastly, expectations for the market for stocks are increasingly high. At the very least, that perception can change or that can disappoint. So there's tons of area where you can get more volatility next year.
Do you believe in the rotation trade, which is something that everyone seems to be talking about?
A little bit. What I'm thinking is, we were going around the desk. Hey, what's the contrarian trade? What's the non-consensus trade? And the non-consensus trade is, everyone says it's the rotation, but suddenly it's become the consensus trade. So I'm a little bit worried about it. What I'm also saying is there's been a lot of talk of bubble, but when we go back and we look at things, the banking sector and JP Morgan has outperformed large swaths of the technology sector over the last 3 and 5 years. And so where the consensus trade is seems to be in financials at this point in time, not so much across the tech sector, believe it or not.
So this really goes to the heart of a question of how much is this market dependent on Fed rate cuts? The rotation trade is, to some degree, the idea that will help bolster some of the more cyclically facing areas. How much is the tech sector also very much beholden on an accommodative Federal Reserve?
I would say it's helpful, but the bigger issue is credit spreads. At 77 basis points, if credit spreads start to widen significantly, that's going to take a lot of risk off. That's going to reprice risk, right? We'll continue to debate whether the Fed's going to cut, how much they're going to cut. Yesterday, it looks like Hassett put 50 on the table. Again, perceptions are going to swing wildly, but really keep a focus, keep an eye on what credit spreads are doing. They're really tight. Right? They stay that way. Things are okay. Things are fine. They start widening out. That's where we have the real problem.
So a question about cockroaches. I'm sorry to bring it back up. It's always kind of unfortunate this early in the morning. But we did see First Brands, which did become insolvent, already run into more trouble. Right. The idea that loans are selling off once again with further questions even after some of the rescue financing. Is this a one-off, or does this indicate sort of loose standards and oversight on the part of lenders, even when it comes to known troubled names?
Yeah, I'll throw out an old phrase. I think there's been too many dollars chasing too few assets, and we have gotten a little fast and loose in certain things. The First Brands looks more idiosyncratic than anything else, but yeah, should you be concerned? Absolutely, you should be concerned. But when we look at the broader market, when we look at high yield and IG, it's performing quite well, and there's still a ton of liquidity there. So we're not worried about it just yet, but we are on, let's just say, we're waving the yellow flag. We're being cautious.
Between now and the end of the year, what do you need to know to get a year-end price target for 2026 in the works?
Well, what I need is a little bit more time. It's been great at CIBC, but it's a ready, fire, aim type situation. So it's been go, 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 and I just really need a little bit more time. That's all.
Right now, yeah. So you don't need actually any answers in the market, just some more time to digest it all.
That's it.
So I'm just wondering, just to finish up here, how different is it to work for a Canadian bank at a time of some pretty fraught relations between the U.S. and Canada?
You know, it's really interesting because you hear both sides of the commentary and both sides of the narrative, and I feel a lot more informed at this point in time. Also, you have a broader view of what's happening, a more holistic view. So for me, it's a lot more informative. I feel like I understand the situation, the issues much better. And because the information is coming from both sides of the border, right? Some things the Canadians see and know a little bit faster. Some things the U.S. see and know a little bit faster. And I'm in a great seat to really understand that and digest it.
Chris Harvey, so good to see you. Congratulations again.
Thank you.
Chris Harvey of CIBC, and happy holidays going forward. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. Chinese AI startup DeepSeek was found to have used NVIDIA's top-of-the-line Blackwell chips in the development of its next major model. Sources telling the information that the chips were smuggled into China through a scheme involving Blackwell chips delivered to servers in other countries before being dismantled and brought into China. Meanwhile, President Donald Trump reiterating that he has a good idea of who he wants for Fed chair. According to multiple sources, the president will begin interviews with the person to replace Jay Powell this week. The Financial Times saying Kevin Hassett remains the front runner, but his selection is not guaranteed. And a Democrat has won Miami's mayoral race for the first time in nearly 30 years. Eileen Higgins will also be the first woman ever to lead Miami. Higgins beat Republican Emilio Gonzalez, who was endorsed by President Trump. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. This Miami story is actually kind of a significant deal. I'm wondering, AMH, your take on it, given the fact this comes after the midterm elections and the shellacking that the Republicans got.
And it's another boost for Democrats ahead of the midterms. The same night the president was out because he talked about how affordability has become an issue. And he said, my team, like Susie Wiles, his chief of staff, said, you need to get on the road ahead of the midterms. There is a lot of concern right now in Congress, which is why you might see a lot of Republicans actually retire because they know that this is going to be an incredibly challenging midterm election for them.
So how did President Trump do last night? Up next, testing the affordability message.
Lower prices, bigger paychecks. Inflation, we're crushing it. The only thing that's really going up big, it's called the stock market and your 401ks.
Sarah Bianchi of Evercore joining next. This is Bloomberg Surveillance. Getting a little bit of a sogginess ahead of that Fed meeting, at least in equity futures across the board, just fading a touch after seeing near all-time highs, led by the NASDAQ 100 futures lower by 0.2%, a similar decline in Russell 2000 ahead of the open. And the S&P futures lower by about 0.1%, possibly due to what's going on in the income space, 2s, 10s, and 30s, seeing just that ongoing sell-off, that bleed upward in yields driven by the long end that we have seen globally. It is a global phenomenon. Nonetheless, the fact that 30-year yields are 4.82% in the United States ahead of a $22 billion auction today at 1 p.m. gives some people pause, as Torsten Slok of Apollo said. Why are these yields rising? You need to ask that question as they become unmoored from the front end of the yield curve. Under surveillance this morning, testing the affordability message.
The new word is affordability. So they look at the camera and they say, this election is all about affordability. I have no higher priority than making America affordable again. Lower prices, bigger paychecks. $1.99 a gallon. How would you like to have $1.99? Inflation, we're crushing it. The only thing that's really going up big, it's called the stock market and your 401ks.
Here's the latest. President Trump touting his administration's economic policies in the battleground state of Pennsylvania, hoping to ease affordability concerns and possibly assuage some concerns in his polling numbers. Bloomberg's Tyler Kendall joins us now. Tyler, what was new from some of his proposals or commentary last night as he tries to get this message under control?
Yeah, hey, Lisa, good morning. To be honest, a lot of what we heard from President Trump sounded similar, though this event was designed to be a kickoff of sorts of what's expected to be a domestic tour heading into the midterms. President Trump really trying to tout his policies in this bid to tamp down on concerns related to affordability, as new polling and also data shows us that sentiment has been souring. Just look at this new survey out from Fox News this week, which shows that 76% of American voters feel negative about the economy. Plus, pair that with election wins for Democrats last night. You had mentioned earlier in the program the win for Democrats in Miami for that mayoral race. I'll also point out Democrats were able to flip a key Georgia state House seat last night, long held by Republicans too. Now, President Trump zeroed in on his tariff policies, saying that he thinks people are starting to understand the benefits of his tariff regime, though did concede that he's gotten some heat, in his words, for those policies. Now, in recent weeks, we've really seen his aides try to urge the public to be patient, even as the administration starts to roll out new ideas, such as investigations into food supply chains. And of course, President Trump floating the idea of tariff revenue rebate checks. Now, it's going to be another affordability issue, though, that's going to ramp up the pressure on this White House as we head into the end of the year. And Congress grapples with that deadline for the expiring Affordable Care Act premium tax subsidies. And Lisa, while it was our understanding that last night was going to be solely focused on the economy, of course, President Trump also hit on some other key issues that we know pull well with his base, including immigration policies and also former President Biden's use of the auto pen. I bring that up because last night on stage, he spoke about this idea of potentially launching an investigation into whether Biden used the auto pen for the appointments of Federal Reserve governors. We should say, experts say, we're not actually expecting an investigation to be launched here. We won't get into all the legal complications associated with this, but I bring it up, of course, because on this Fed Day, it just shows us another illustration of how President Trump has been ramping up the pressure on the central bank.
Tyler Kendall, thank you so much. And I'm really glad that Tyler brought up the auto pen issue, because on one hand, you got to say he can't be serious. On the other hand, maybe this will lead to an investigation, because clearly this administration wants to get a greater majority on the FOMC.
Well, he called out Scott Bessent, not just saying that he's a perfect exterior, but saying he's going to check on this because he says it is a problem going after these four individuals that were appointed. Of course, Powell was reappointed, but I'm thinking of Lisa Cook, Barr, and Kugler that were appointed by the Biden administration. I think it just signals that this administration is looking at the Fed a little bit more holistically, not just the chair, and they really want to remake it. But these are Senate-confirmed individuals. This is going nowhere.
Which is, but it does underscore this question around affordability, around the Fed's role, and exactly what this administration can and will do in order to address the problem. Sarah Bianchi of Evercore ISI joins us now for more. Sarah, I want to start there. This idea of how much are you looking at the potential for this administration to truly take actions in the next few weeks, as we do get a sense that polling really is shifting away from the president when it comes to the affordability message?
Well, I'm not sure he's going to be able to take action in the next couple of weeks. But I do think that looking into 2026, the State of the Union is going to be critical. And it's very hard for presidents in this kind of situation not to be defensive, not to defend their own policies. But I do think by the time he gets to the new year, he's going to have to come up with some policy ideas. The tariff rebate, probably the most specific that we've seen, but he'll want to put some ideas, more ideas out on housing, energy, and then, as you mentioned, figure out what he's going to do in this healthcare space.
Sir, when it comes to the president's speech last night, he once again talked about how the word tariffs is one of his favorite words. At the same time, we do see the administration looking at some tariff rates on especially food products, agricultural products, and they're actually clawing them back. Do they have a message that they need to recalibrate when it comes to trade?
Well, it's really interesting. The size and scope of the food tariffs really wasn't particularly significant. And so while I do expect them to claw back in some areas, I expect, generally speaking, the tariff overall tariff rate to stay relatively constant next year. That's even likely through what we think will probably be a loss in the Supreme Court. So he is making some adjustments, but by and large, this is his signature policy, and I think they're going to try to keep it as intact, at least as they can.
If you think they're going to lose the ability to use IEEPA, what are you planning for that? Especially as you were a former trade representative, what are you planning for then in terms of what this administration is going to put in its place?
Well, they can do a series of 301 investigations, and there's a lot of legal precedent for that. The challenge is those do take time. It's a little bit strange to do it on so many countries as they would have to do to replace IEEPA, but again, we think they're fairly committed to this. There is a question of how they might bridge the gap because those will take a bit of time. There's some authorities, Section 122 has been mentioned, that allows for a 15%. But I think our general message to the market is, look, at this point, when we're sitting here next year, maybe tariff rates will be a little bit lower than they are today, but don't expect them to go anywhere near where we started in 2025, which was quite low, 2 to 3%.
When it comes to China, the administration, as you know, is now giving the green light for H-20s to go to Beijing. And we do see that the Chinese government is calling on these companies and seeing what the appetite is. And it seems that the appetite is there. Do you think this administration is putting the economy and trade above national security?
Well, I certainly think that many of the kind of MAGA advocates and China hawks in the administration and outside of it are concerned that the kind of pro-tech AI parts of the administration continue to be winning. There are a lot of people who argue that selling those chips is a national security risk. But irrespective of that, you see again and again calling for federal preemption of state regulation of AI, chips, deregulation. So a very, very pro-AI posture that the administration has taken this year, obviously helping fuel the market and economic gains we've seen. But I do think as they get into the midterms, there are a lot of people, including Steve Bannon, who are saying, watch out, this stuff's not very popular with the MAGA base and with lots of Americans.
Well, it raises a question. The information is reporting this morning that DeepSeek is using banned NVIDIA chips as it does create some new, more efficient models when it comes to search and other AI technology. How much do you see this as being the source of a real flare-up in terms of tensions between the U.S. and China in the upcoming months?
Well, the administration is doing its best to keep things calm in what is a very fragile détente. You hear Bessent and Jameson Greer saying, oh, everything's going well. They're implementing everything that we've said, kind of nothing to see here. And some of that is to, again, maintain stability, to try and give the United States some time to catch up around rare earths. But you're also starting to see Republicans in Congress and governors and state AGs a bit more vocal on this as the president's numbers have come down and they start to feel a bit more liberated to be more full-throated on their own views. So I do think it's very possible that you could see more and more people start to raise concerns, whether it's the selling of these chips, whether they have chips they shouldn't have. I think this will continue to be fraught in 2026, and it will be very hard to maintain this fragile détente without any disruptions next year.
Sarah Bianchi of Evercore, thank you so much for being with us in this report from the information saying that NVIDIA's state-of-the-art Blackwell chips have been smuggled in and have been behind some of the gains that we've seen from DeepSeek.
And those chips, Blackwell, is banned in China. Right now, the administration is giving the green light for the H200s, but Blackwell is banned. And at the same time, we talked about this yesterday, is the administration doing one thing and saying another, given they are going after smugglers for the H200?
We've got more on that coming up. Also, Lindsey Piegza of Stifel as the search for the next Fed chair enters the final stage. Some skepticism ahead of the Fed meeting later today. A question around just how much the Fed is poised to disappoint a market looking for Fed rate cuts, not just this year, but really heading into 2026. Right now, just a little bit of a softness in equity futures ahead of the open, down about 0.1% on the S&P. A little bit of dollar weakness. We've seen real stability in the FX cross just because there are as many concerns over in Europe as there have been here in the United States. Watch this space, though. The big question this morning, why are long bond yields rising so much globally? In the United States, 10-year yields in the U.S., 4.2%, up almost 2 basis points this morning. That is up from 4.07% the last time the Fed met. What is going on here? Silver prices, meanwhile, at another all-time record high, up 0.6% in pre-market trading. 2 hours away from the cash open, here are your morning movers. Danny Berger. Danny.
Hey, Lisa. Starting with GE Vonovia, reporting earnings incredibly strong, upping a dividend, upping its buybacks, upping its projections. For electrification demand, they see their backlog doubling by 2028. That's thanks to the demand. You guessed it. AI data centers, those shares up 10.4%. Also trading higher this morning, Palantir reaching a new deal with the U.S. Navy. The U.S. Navy, for their submarine services, will be using Palantir technology. That contract worth about $450 million. So those shares moving higher by 1.2%. Rounding things out with earnings, we got at the top of the hour, and that is the pet company, Chewy. Shares are up 3.3%. Sales mostly in line to a little bit higher. But again, maybe these more consumer-facing companies, there's some fears around. So that was good news. The company CEO also saying that they are growing. They are taking market share, so shares up 3.33% to the pre-market. Lisa.
Thank you so much. Always taking a look at pet food as a key gauge of people's devotion to their pets and consumer appetite. Right now, under surveillance this morning, Chinese AI startup DeepSeek has been using NVIDIA's top-of-the-line Blackwell chips to develop its next model. Sources telling The Information that the chips were illegally brought into China, where they remain banned through a complex smuggling operation. This follows a discussion yesterday around a DOJ probe to 2 individuals about possibly smuggling H200 chips. These are the more advanced version and really underscore some concerns about the relationship between these 2 countries.
And what does the U.S. government do, especially since they are trying to make sure that the temperature is low, on a low boil when it comes to China and the United States? The president will be going there early next year. He had this détente with Xi Jinping, and now they're giving the green light for the H200s. At the same time, the DOJ is actually going after smugglers of the H200s. So they really need to decide what is the strategy going forward, because at some point we have seen this administration say one thing but do another when it comes to national security concerns and export controls.
So back in October, when President Trump met with Xi Jinping, he said that Blackwell is 10 years ahead of every other chip and that China would not have access to them. This information report says that actually DeepSeek had access to the Blackwell chips in the last quarter of 2024, at the same time that companies including Google, Microsoft, and OpenAI started to receive them, really raising questions about, first of all, how much the U.S. is going to do in terms of creating this distance, this bifurcation in the chip world between the U.S. and China, but how effective they've been to date.
How effective they've been to date in terms of making sure that these chips don't get into the wrong hands. Clearly, they are happening. And remember, when DeepSeek came onto the scene earlier this year, people were saying, don't you think part of this has to be them stealing U.S. chips that are banned in order to have this level of technology? And I go back to what Jensen Huang has said many times, and he's recalibrated a little bit because it's politically fraught, but he has said basically China is neck and neck with the United States when it comes to the arms race.
Yeah, and how much does this potentially increase that race? Meanwhile, President Trump suggesting he could remove Federal Reserve governors appointed by President Biden if their commissions were signed by AutoPen. The president asking Treasury Secretary Scott Bessent to investigate.
Have you checked that? Are you hearing it? Who signed it? Did he sign it or did the AutoPen sign it? I think it's something we have to look into. They put people there that are not authorized to be there. I'm hearing that the AutoPen could have signed maybe all 4, but maybe a couple of them. We'll take 2.
The Federal Reserve declined to comment on the president's claim. It does raise questions, though, how far the administration is willing to go to try to get some more dominance and control over the FOMC.
I think it signals that they really do want to remake the Federal Reserve. A lot of administrations come in and their goal and dream is to maybe get someone on the Supreme Court, right, for a legacy. This administration really seems the Federal Reserve in the same way. And they understand, you heard Scott Bessent recently talk about this, understands that the Fed chair definitely has an enormous amount of clout at the Federal Reserve, but it's a deliberative body. So they're looking at potentially, they've already done so with Lisa Cook and looked at potentially these other individuals, but this would mean a ton of legal pushback, and also these individuals were Senate confirmed. So not really going anywhere anytime soon.
Yeah, the Fed meeting today at 2 p.m. We get that rate decision at 2:30 p.m. We get Fed Chair Jay Powell's press conference. We'll get more on that in just a second. Amazon and Microsoft announcing a combined $52 billion investment plan for India. Amazon planning to pump $35 billion into India by 2030 as Microsoft commits to more than $17 billion.
It's fantastic to see this all landing and ultimately being able to parlay these tokens per dollar per watt into all of the application systems that are going to get deployed broadly across the country. And so the $17.5 billion, which is the largest investment we made in Asia to date. And so we're thrilled about it.
Google also recently pledging $15 billion to build data centers in India. Turning back to the Federal Reserve, President Trump reportedly planning to start his final round of interviews for the Fed chair in the coming days. The frontrunner, widely believed to be National Economic Council Director Kevin Hassett, who said there is, quote, plenty of room to cut. Joining us now is someone who disagrees with that statement, Lindsey Piegza of Stifel. Lindsey, you've been really vocal on the fact that you do think that inflation is very much a preeminent concern and is being underplayed by this particular Fed. How much do you expect that to come to bite the Fed when it comes to really yields, which is what we're seeing this morning?
Well, I think the Fed is well aware of the fact that inflation remains a very sizable problem. As we see, the majority of Fed officials have come out and spoken against, or at least questioned the need for further rate cuts. So there's a very clear divide among Fed officials right now, some focused on the employment component, but still, as I mentioned, a majority concerned that we did not do enough the first time around to reinstate price stability. And now it becomes even more of a challenge for the Fed to get us back to 2%, having left prices well above that target level for so many years now.
Where is the inflationary pressure coming from, given the fact that people have seen rent prices actually come down, not just disinflation, but outright deflation in a couple of rent metrics? And we are seeing pretty contained price increases, certainly during the holiday season, even on consumer goods. So what's going to drive this?
Well, there still is some improvement. We have seen some improvement, as you mentioned, in these pockets. But when we look at the cost of services, this is still going up consistently over 0.3 on an average monthly basis. So that's continuing to fuel these overall annual inflation numbers up near 3%. Remember, it was never about getting us down from 8 to 6 to 4, close to 2%, but back to 2% on a sustained level. And the Fed failed, as I mentioned, to really bring us to that sufficiently restrictive level the first time around, stopping short at 5.5. And so now the Fed continues to contend with above trend price pressures.
Does this get worse when the president gets his pick for the Fed chair?
I think the Fed is going to have more of a lean to the dovish side. There may be more of an inclination to err on the side of additional rate cuts, as opposed to holding steady, moving to the sideline, waiting for the data, depending on who takes the lead at the Fed. But remember, all of these members are pro-growth, pro-market economists. They're looking to support the economy. They're looking to meet the Fed's dual mandate, and they will base policy appropriately to achieve that legally mandated goal.
When you look at potentially inflation next year, where is that coming from? Is that coming from like almost a self-induced crisis in Washington because the one big beautiful bill and maybe these $2,000 dividend checks?
Well, so this is one of the biggest concerns. Right now we're looking at inflation and we're saying, okay, there's not necessarily a tremendous amount of upside momentum that we're concerned about. But as we turn the calendar page, if we see a stronger growth profile than expected, right now, according to the Atlanta Fed, we could see Q3 GDP up over 3.5%, much stronger than what the Fed had anticipated. We're still seeing a very spendy, solid consumer as we go into this holiday shopping season. And my biggest concern is businesses drawing down inventories, eating into profit margins. If they begin to pass through more of these tariff-related or other policy-related costs onto the end consumer, any one or a combination of those factors is going to drive inflation higher. So we can't get ourselves in a position where the Fed eases dramatically and then quickly we have to reverse course because inflation is taking off up near 4% or beyond.
I just feel this but coming in.
Yes.
All these people who are listening to this saying, but that GDP number was really driven by data center investment. And what we're seeing right now, potentially next year, is greater efficiency, greater productivity that could fuel both growth but also a disinflation. That was
there
really
is
what a lot of people
disinflation
think
on the AI side, absolutely. Increasing productivity, increasing efficiencies, as you mentioned. But there's also an inflationary component, too, driving demand higher for these AI services, as well as this sizable energy component, driving higher demand for data centers. So it's not necessarily a clear-cut argument that AI is going to, or other technologies are going to drive inflation down. There still are a lot of question marks. And if we factor in tariffs, if you factor in consumer and growth prospects, I think the risk still remains to the upside.
Where's the political risk here in the case that you just made? You talk about how it can be inflationary, and then you think, okay, energy costs. And we are going to be speaking with the Chevron CEO, Mike Wirth, later on. It should be a great moment for energy costs, at least from the producer side, because you should see them going up because of how much energy is in demand.
Well, we have seen energy go up over 40% in just the last 5 years.
But we haven't seen oil prices go up. And this is sort of the question of at what point can you factor in government interference in trying to skew prices to the downside because of some of the political concerns, leaving a sort of subdued inflation, even if the supply-demand dynamic might otherwise signify something else?
Well, there will be pressure on the administration to step in. As we know, the fastest way to derail the American consumer is sustained heightened energy prices. And that will show up in the polls, be it the midterms or other. And so there will be a lot of pressure on the administration to step in, not necessarily with a long-term solution, but certainly with some short-term reprieve.
Well, that's with electricity. Is it balanced out with the fact that the president last night was talking about gasoline $1.99? So then I looked, and actually there is a gas station in Oklahoma that has a gallon for $1.99. In Colorado for $1.69, the Gas Buddy has everyone mapped out. And I said, wow, they really are that low, below $2 a gallon. But the issue people have at home is electricity prices.
Right. And
do they negate each other?
For the household balance sheet, the average consumer will look at where they're allocating those funds, be that to the gasoline tank or be that to the household energy bill. And so if one is improving and the other isn't, we're still going to feel that pressure as normal consumers, normal spenders.
Lindsey Piegza, it is great to see you in studio here.
Thank you so much
for being here, and happy holidays.
Happy holidays.
Lindsey Piegza of Stifel on the Fed debate later today. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. Money manager Mario Gabelli saying it's, quote, highly likely he will tender his client's Warner Brothers shares to Paramount in an effort to spark a bidding war. The media investor is signaling he favors Paramount's deal, but saying it will have to increase its $30 a share bid, and Netflix will likely still counter. Meanwhile, JP Morgan announcing $105 billion in expected spending next year, higher than the top estimate from analysts surveyed by Bloomberg. The Consumer and Community Bank is a big driver of the expense growth due to higher compensation for advisors, product marketing, building branches, and investing in AI. And the U.S. is proposing that foreign visitors provide their social media history over the last 5 years to enter the country. It would apply to travelers from about 40 countries who can stay in the U.S. for up to 90 days without a visa. The proposal was given a 60-day notice. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, a tech paradigm shift.
The spend has been enormous, and to some degree, some of these companies don't have the revenue to back up that spend. It's a paradigm shift between companies that were all cash generative to companies that are now using that cash, companies that were asset light to all of a sudden having assets.
Tony Rodriguez of Nuveen joins us next to talk about, in part, the fixed income side of this story. This is Bloomberg Surveillance. Good morning. It seems like in Washington, D.C., people are waking up and realizing they're going to have to come out, message a Fed rate cut, meaning 175 basis points of rate cuts since September, and then giving guidance at a time where there is none. economically. Right now, we're looking at S&P, NASDAQ, and Russell 2000 futures all lower ahead of the open, led by NASDAQ. Tech futures down about 0.25%. Similar move for the Russell 2000. S&P lower by about 1/10. It really has to do with the bond space, especially ahead of this Fed meeting. 2s, 10s, and 30s. The long end of the yield curve, not just here in the United States, but globally, has been rising substantially. As Torsten Slok was saying of Apollo, a fixed income mystery. 30-year yields up about a basis point, 4.82% ahead of an auction later today, $22 billion of notes, and 10-year yields hovering around that 4.2% after climbing to the highest levels going back to the end of September globally, the highest 10-year bond yield globally since 2009. Under surveillance this morning, this has been the focus for tech, the tech paradigm shift in debt.
The spend has been enormous, and to some degree, some of these companies don't have the revenue to back up that spend. Some of the companies are using their balance sheets. Some of them are going to be taking out debt. This is going to be a big switch. It's a paradigm shift between companies that were all cash generative to companies that are now using that cash, companies that were asset light to all of a sudden having assets.
Here's the latest. People looking ahead to the Fed meeting to really understand exactly how much more room some of these tech companies have to issue. Is it because there is an accommodative backdrop in credit markets, really ameliorated by the easing of Fed rates? Right now, we are so grateful to have Tony Rodriguez, head of fixed income strategy at Nuveen, here with us in studio. We're going to get to the tech space and just what exactly we can expect with issuance and what this means. But I want to start on the Fed and how much it's fueling some of this risk-taking appetite. How much do you think that the 175 basis points of cuts that are expected after today's meeting since September have really eased financial conditions in a way that's underappreciated?
Well, I definitely think they have eased financial conditions. We see that across all markets, whether you talk about commodities, equities, and certainly the credit markets from high grade to high yield. So the new issue spigot is wide open. We've seen over $1.5 trillion of new issuance in investment grade space this year. So yes, financial conditions are easy. That is certainly prompting some of the borrowing. But when we talk about the specific kind of boost we've seen from hyperscalers and AI-related investment, we think that's a little bit more just secular in nature. We're going to see that over the next, people are talking about $3 trillion worth of CapEx over the next 3 years, half of which probably comes to the public debt and private debt markets. So that is not really kind of Fed-induced in any way. That is really structural and secular in our minds.
How much does this secular wave of issuance really feed into this rise in yields that we're seeing globally? How much is the idea that there just is a glut of bond sales coming down the pike as the financial world has to suddenly finance the physical world in a way it hasn't for so many years?
Yeah, the technical supply pressures are large, both in credit markets because of hyperscalers, but also in sovereign markets because of the high debt levels that we see really across the globe. So the kind of sovereign story is one of really steeper curves, long end suffers. So we're seeing that in the U.S., but we're really seeing it globally as well. So those fiscal pressures, there really is, as far as the eye can see, no relief for that. When we talk about the credit markets, what we're seeing there is the technical pressures hitting high quality, technology, and the long end. That's really where the concentration has been of supply coming from, the Mag 7 type hyperscalers.
So parlay this into the question that we've been asking all morning, which is why are sovereign bond yields rising so much on the long end while they seem relatively pegged on the front end? Is it because of the supply issue? Is it because of some of the deficit concerns? Or is it something else entirely?
I think it's around the deficit concerns primarily, but we've also seen some stronger growth numbers over the last couple of week or to 10 days. You think about the German data, where a lot of people thought Germany was really kind of one of the weak sisters in Europe, saw some strong data. So a little bit better kind of data on the growth side. But the fiscal concerns, whether it's because of defense spending, whether it's because of, fiscal spending in the U.S., which is beyond strategic and defense, that I think is really pressuring the long end. Term premiums we've seen rising for since September, really. That we think that pressure is going to remain in place. So you're seeing it in the long end of not only the U.S. curve, but global curves as well.
Is this going to continue in the U.S. if the Supreme Court decides to strike down IEPA? Or this administration does decide to do these $2,000 checks?
I definitely think it's going to continue. Even if they strike down IEPA, we still think they'll be able to implement the vast majority of the tariff policy through other means. So we don't really see much of a change there.
But that's good for the deficit, right?
Well, we think it's okay for the deficit. It's not good for the deficit. A lot of that's already baked in. So, really what it's most negative for is really around the consumer. and higher prices and kind of the stress we're seeing there, particularly on the low end of the consumer. So from a fiscal side in the U.S., I mean, right now we're talking about 6 to 7% deficits for the next 4 to 5 years. So unless there's really something structurally changing on the spending side or the revenue side, it's unlikely we're going to see any relief in the long end. So we think long end rates stay steady. The front of the market might rally a bit here following the Fed over the next 6 months.
So steepening yield curves. What are you looking for in terms of messaging from Fed Chair Jay Powell later today? We were talking earlier about how he is a lame duck, not a dove or a hawk. How much does he really have control over the committee and have the ability to signal to markets what the path ahead for the Fed really looks like?
Yeah, I mean, I think his ability to do that is certainly compromised now, lame duck status, along with all the other pressures that are coming down on the Fed. So what we think they'll do, they're going to cut. They'll try to make it a hawkish cut, but I think it'll be quite subtle, really more from the standpoint of instead of talking about, additional policy moves, they might talk about the extent and timing of additional adjustments. So trying to kind of introduce a little bit of just ability to pause over the next couple of meetings. We think they'll go one more time before Powell is done, called maybe the April meeting. And then we think that would probably be it under maybe a Waller or if Powell were to stay in power. If you go with a Hassett, then we start to think that there's probably a second half of next year an additional cut. So we get today's and 2 more, whereas fundamentally the economy is probably going to be okay with just today's, maybe 1 more in the middle of next year, and that gets us pretty close to neutral and maybe a steady state for a bit from the Fed.
So just taking a step back, what's your highest conviction heading into next year if you do think the economy is in a pretty good place, but potentially this Fed could cut more than is economically warranted?
Well, we think that the best place to be really is kind of the mid-quality level of the credit markets. So we expect some weakness in the high-quality areas I mentioned because of excess supply that's coming. We expect some weakness in the lowest end because our growth forecast is for a little bit below 2%. So that's an okay environment for growth, but the weakest companies might have a little stress. So kind of mid-quality credit in a diversified fashion, to us, that's the sweet spot. Earn the carry. You're not going to get a big tailwind from lower rates, but we're not expecting a big spike in rates either.
Just real quick here, if the Fed does indicate that it's going to cut rates substantially more in the upcoming year, do you expect the long end rate to rise substantially more than we have seen already?
I think it would rise beyond our current. We think maybe 4 3/4 for the 30-year, let's say, 4% for the 10-year. We could see 50 basis points higher than that if you had significant additional cuts that are clearly not motivated by fundamental economics.
Tony Rodriguez, thank you so much for being with us this morning. Tony Rodriguez of Nuveen. As we head toward that Fed meeting, and frankly, as we head toward a question around one of the more indebted of the tech space, Oracle reporting earnings after the bell, and a question of supply. It's not just the government supply, it's also very much the corporate supply that we've seen from some of these AI leaders.
Tony said it, $3 trillion. It's unbelievable when it comes to how much money these tech companies are tapping in the debt space to finance this entire AI build-out trade that a lot of people still have a tremendous amount of questions and concerns about.
Right now, what you're seeing in markets is a little bit of softness ahead of that Fed meeting, as well as those Oracle earnings. And you can see those bond yields on the long end just creeping up. When we talk about the incredible amount of build out in the tech space, you have to wonder about how that affects the energy costs. We'll be talking about that coming up. First, we've got Gargi Chaudhuri of BlackRock, then Chevron CEO Mike Wirth. Do not miss that. Tiffany Wilding of Pimco, as we do get the employment cost index from October, and Robert Tipp of PGIM Fixed Income. We start to look at a Fed cutting rates into already pretty easy financial conditions. Right now, what you are seeing in markets, silver rising to an all-time high as maybe people look to precious metals ahead of this meeting. Right now, this is Bloomberg Surveillance.
We think the setup is really constructive into next year for a broadening in earnings.
There's this element that maybe things could be better, and you have a lot of stimulus coming.
Let's not be complacent and just expect the same really positive performance we've seen so far this year.
If you start to see any kind of degradation in earnings, I would be much less optimistic.
The market tends to discount both good news and bad news fairly quickly.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance on Fed Day, with stocks fluctuating near all-time highs ahead of earnings from Oracle and that key Fed rate decision at 2 p.m. Eastern. Traders expecting central bankers to ease policy for a third consecutive meeting, but the path after that increasingly murky and increasingly underpinning skepticism that we could see in the bond market.
Actually, what we're seeing today in the bond market, if you've been talking to, just yields continuously rise. A lot of people have different reasons why. Tony Rodriguez just talking about deficit concerns are still an issue in the United States. A lot of people are talking about actually this is just a global phenomenon right now. When you look to Japan, Australia, Canada, hiking or hikes priced in. What the Fed has to do today, I guess everyone can ask Jay Powell about why he thinks yields are on the rise, but he is a lame duck today. And I think what's going to really overshadow this is not just the fact that we had a 43-day government shutdown. We don't have the latest job data as they make this decision. But what happens next year as we have musical chairs at the Federal Reserve?
Especially given the fact that right now we're in a data desert. We haven't been getting economic data. Today we'll get at 8:30 a.m. Eastern some employment cost index that is dated, but might give us a sense of a labor market that has been absolutely a mystery. What we are expecting is also a statement of economic projections. How does this Federal Reserve give an economic projection, given the fact that it really is a huge debate about the momentum in the economy and, frankly, even what has happened over the past couple of months?
Well, the problem is, to this data desert, we don't exactly have a clear picture of what happened. Jobs and retail sales numbers for October and November have yet to be released. The Fed is meeting today, yet they get the jobs report next week. So potentially next week, they're either going to give themselves a pat on the back and said, yes, we made the right decision, or they're going to, but some of them might walk out of there and think, oh, maybe we should have had on pause, have gone for a deeper cut, because right now we heard from Nela Richardson, there are green shoots when it comes to the labor market. When you think of there are some hiring. We saw that in JOLTS yesterday, but then she talks about concerns in small businesses.
Yeah, so how useful will the dot plot be? It always is incredibly useful, of course, but this time, how useful will it be? The expectation is for one rate cut next year and one rate cut the following year in that dot plot. Again, do you just throw it all out the window? Right now, the state of play that you're seeing in markets is a little bit of softness in the equity space. Futures lower by about 0.1% on the S&P. A bigger decline in the tech area. You are seeing a pretty flat market when it comes to FX, but the yield space, as Annmarie was mentioning, 10-year yields up about a basis point, had been up more, but fluctuating around that 420 level. Coming up this hour, Gargi Chaudhuri of BlackRock, with stocks wavering, Chevron CEO Mike Wirth, as gasoline and oil prices are trending lower, and Tiffany Wilding of Pimco, expecting a more hawkish Fed in 2026. We begin this hour with stocks just slightly lower as traders await the latest interest rate decision by the Federal Reserve. Gargi Chaudhuri of BlackRock joins us now. Gargi would love to be a fly on the wall in the Fed's meeting today. Thank you so much for being here. Why do you think this is going to be such an exciting meeting down in Washington, D.C.?
Absolutely. Thank you both for having me. And as I was preparing for this, I was looking at the S&P dot plot. And to your point, maybe you take it with a grain of salt, maybe you throw it right out, but it does give us some information. And one of the things that I was looking at is the estimates for neutral from September. And if you remember that, you'll notice that at least 4 or 5 of the members had already at that point said that we were near the neutral level, which we are at today. And then obviously with the 25 basis points cuts that are going to come, many will have already thought that that was not needed. So whether or not there's going to be as many dissents as many expect, I don't know. Personnel is policy. I think Chair Powell will probably do a great job in building consensus. He's done that many times, but the discussions will be fabulous. And I think we learn a lot from the minutes in 6 weeks.
I love generating consensus. I thought you were just saying herding cats, because that's what it always feels like. But meanwhile, Torsten Slok puts out a note this morning saying a mystery in fixed income, and that really the key question, as we've been talking about extensively, why are long-term rates rising so much if the Fed might be poised to really cut rates more than even might be warranted? As people worry or think about there could be potentially a political motivation to lower rates, why are long-term yields rising globally to the extent they are?
Yeah, so I think the last part of your sentence, globally, is important. So this isn't a US-centric matter. It is rising globally. I think there are a few concerns there. Number one, I think the person that was here before me spoke about just generally concerns around fiscal discipline. That is something that hasn't gone away. We were thinking about it 6 months ago. We're thinking about it now. I would question why we had rallied so much. Why were we below 4% not that long ago, especially when we didn't have too much data? Now, I think having sort of sold off back to this 420 level with some expectations of hawkishness, almost everybody that you speak to expects this meeting to be hawkish. And it's hard to imagine that Chair Powell can be dovish given all of the foregone conclusion language that he had used in the last meeting. So I think some of that is also just expecting the, pre-pricing the hawkishness. What I think we should all focus on is the opportunity that this backup in yields is creating in a world where so many other parts of the market, if you look at, just broad indices, have rallied so much, but bond markets, especially that belly of the curve, creating this opportunity for income, I think it's pretty fantastic.
So what do you like when you look at opportunity?
Yeah, so a couple of things. Number one, within the fixed income market, we're telling investors that the backdrop of solid growth with a Fed that's either going to pause or, maybe cut one more time in the beginning of next year, that creates a wonderful opportunity to clip coupon. But really, you don't want to take too much duration because of the fiscal concerns that we were talking about. So really keep it maybe out to the 10-year point, belly of the curve, focus on income, focus on all-in yields that are available in the fixed income markets. Within the equity space, the core of your portfolio needs to be in large cap. And that's because we think that even though small caps have rallied so much, it's not going to be sustainable in a higher rate regime. So large caps, AI are a focus, and then a lot of diversifiers around it, because obviously, as we've seen, there's a lot of pressure to pull back when, news arises, and we might see that today.
So are you a believer in the rotation trade or not yet?
A rotation trade into
small, mid cap?
No. So I actually think I'm quite in the opposite camp, where I think that the small cap rally that we've seen in the all-time highs has gone a little too far. In fact, what we think is we should rotate back into the large cap space, which should be the core of your equity portfolio, with some allocations to other themes such as cyclicals, especially in financial space. We think dividends as a source of income can be really powerful here, but really keeping large cap at the core and the belly of the curve in fixed income as your fixed income allocation, with other diversifiers like gold, with liquid alternatives.
Which is the reason why I think a lot of people have been going into gold, and it has rallied some 7% since the last Fed meeting. How does tech play into this large cap emphasis that you're putting out there? We're going to get Oracle earnings after the bell, an increasing focus on the connection between big tech and the debt markets, given the financing needs of some of these companies. How much do you need that to perform? The idea that these companies can continue to get the financing at relatively attractive pricing in order to keep building out and generating the optimism that they have in 2025.
Absolutely. And I think one of the things that has changed this month over maybe 3 months ago is new deals being announced is not viewed as a positive thing anymore. But where they're coming from is important. So if you have these large tech companies that are actually really profitable, have a lot of free cash flow, at the same time have very little net debt, we all know that chances are likely very high that the companies will be able to finance this appropriately. And I think maybe there'll be pullback in the credit market, but over the long run, at these level of all-in yields, the supply will likely be absorbed, but who's doing it matters. So the free cash flow generating, low net debt, high EBITDA companies that are then coming into the credit markets, I think that goes okay. But obviously, when it comes from other parts where there isn't that free cash flow associated with the names, I think that could be a little bit trickier. But one of the things that we've seen over and over in 2025, this being one of the years that we've seen a record amount of fixed income flows, is investors want multi-sector fixed income in their portfolio. They want that income. So every time you have these massive issuance weeks, you actually do see a lot of demand come into fixed income markets.
Let's say you were down in Washington, D.C. today. What would be the one question that you would have to Fed Chair Jay Powell in the press conference? If you were there, Gargi Chaudhuri, in the front row, what would you be
I've thought about this. I would love to be there. Shout out to Mike McKee. But I think I'd ask Chair Powell what he would need to see in the deluge of data that we're going to get in the next month or so to decide about what drives market rates in January and March.
Gargi, wonderful to see you. Thank you so much for being with us today. Gargi Chaudhuri of BlackRock here in studio as we do count down to that Fed decision. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. President Donald Trump suggesting he could seek to oust Federal Reserve governors appointed by President Joe Biden if their commissions were signed by AutoPen. Trump asked Treasury Secretary Scott Bessent to investigate the issue. AutoPens have been used in multiple presidencies tracing back to the 1940s. Meanwhile, lawmakers in Brazil have approved a bill that could lower former President Jair Bolsonaro's jail time. If it passes the Senate, the legislation would curb prison sentences for Brazilians convicted of crimes linked to the insurrection attempt after Bolsonaro's loss. Bolsonaro's sentence could go from 27 years to 20 years and 9 months. And money manager Mario Gabelli saying it's, quote, highly likely he will tender his client's Warner Brothers shares to Paramount. The media investor signaling he favors Paramount's deal, but saying it will have to increase its $30 a share bid, and Netflix will still likely counter. The bidding war is expected to last well into 2026. That's your Bloomberg Brief. Lisa?
I'm getting Jerry Maguire feelings. Show me the money from all of the shareholders. Up next, the morning calls, plus Chevron CEO Mike Wirth. His gas prices have dipped below $3 a gallon for the first time since 2021. Is it still drill, baby, drill? That's next. This is Bloomberg Surveillance. Seeing a bit of softness ahead of that Fed meeting. Good morning. Just a little bit of a dip in futures this morning. It could all change, clawing back from some of the earlier losses. Quiet in the FX space. 10-year yields higher by a basis point, 420, continuing that sell-off, and silver prices at all-time highs. We haven't been citing oil prices, and the reason is because they have been staying in the same place, fluctuating from gains and losses, but really around that $50 to $60 a barrel, with a lot of questions around supply, not just the demand side. Time now for the morning calls. First up, HSBC raising its price target on Eli Lilly to $1,070, calling it positioned to outperform next year, especially if AI panic kicks in. Next up, Citi lowering its target on Cracker Barrel to $20, citing declining traffic, not exactly the logo incident, down 3.1% in pre-market trading. And finally, Morgan Stanley raising its target on ExxonMobil to $137 a share, highlighting increasing free cash flow. Those shares up by 0.3%. Let's stick with the energy space. President Donald Trump touting lower prices.
We're down lower than we've been in 7 years in gasoline prices and oil prices, not just the 3 states that I talk about with $1.99 a gallon. How would you like to have $1.99? You know, that's the equivalent of a very major tax cut, you know, when you get the energy prices down.
The national average for gas falling below $3 a gallon for the first time since 2021. Mike Wirth, the CEO of Chevron, joins us now for an exclusive interview. I am so glad that we're getting to speak with you, Mike. Thank you so much for being here with us.
You're welcome, Lisa.
So let's start about that. $1.99 a gallon. It might be great for a lot of people in terms of filling up their gas tanks. A real question around drill, baby, drill, and how much you're incentivized to increase production given the lower cost of oil.
Well, you know, we make our investment plans on a long-term basis. We look at supply and demand well out into the future. And so the price of oil today can affect short-term financial performance of the company, but it really doesn't play as much into some of the longer-term investment plans as we look down the road, not really out the window, as we decide what the capital program looks like.
But how do you reconcile the two? Because you're doing a lot of exploration internationally. And to Lisa's point, prices are low and potentially are going to even go lower.
Well, exploration is a long cycle business. We just brought a project online in the Gulf of America last year where the discovery was made 20 years prior. And so the timeline between when you actually make a discovery, when you appraise that, and you ultimately develop it and bring it to market can be years or even decades. And so we really have to take that long view on the business. And, in the short term, we'll keep costs tight. We've guided to, industry-leading free cash flow over the next few years as we bring costs down, capital spending down, increase the synergies on the Hess transaction. So we're going to deliver strong financial performance through the cycle.
Based on what the IEA has said, recalibrated where they see oil demand growing, it was 2030, now it's 2050. OPEC says they had a rendezvous with reality, seeing that the world needs a lot more of this, a lot more fossil fuels. If outlook is so strong, should Chevron, should all of these big oil companies, should they be increasing more of that investment?
Well, on the IEA, even a broken clock is right twice a day. So they have finally acknowledged what we've long known, which is that the world will continue using oil and gas for many decades into the future. We are in that long cycle business, and the capital spending, Annmarie, has become more efficient in our industry. A decade ago, we were spending money on big projects. There was a lot of growth going on in shale at a relatively high cost structure, and the entire industry has found ways to standardize designs, simplify projects, and actually get more for every capital dollar that we spend. So the size of our capital spending doesn't necessarily correlate to the growth the way that it would have in years gone by.
When it comes to expansion, the U.S. government is backing this plan Iraq has to transfer Lukoil stakes to an American company. So it's really only you or Exxon. How are those negotiations going? Well,
I can't comment on commercial negotiations. What I will say is we've got a well-established reputation as a good partner, as a world-class operator in international locations. We're sought out as a partner in countries around the world. We've got a long history working in the Middle East, and we put a real premium on partnership, and that goes to every country we work with and every company we work with.
Can you talk about those assets, though? Do you think those would be good assets to the Chevron portfolio?
Well, we always look to strengthen our portfolio. Iraq is a country that's blessed with very substantial petroleum resources and some of the largest fields in the world. And so those are the kinds of things that we always look at.
You've been talking about the capital profile and investments and how it's become a lot more efficient to make the same kinds of investments and frankly, the same kind of output. Where is this efficiency coming from? Is it coming from artificial intelligence? Is it coming from just better technology and getting oil and gas out of the ground?
Yeah, so in shale, for instance, which is something the U.S. has been a world leader in, a decade ago, break-evens were $70 or $80 a barrel. Today, they're not even half of that, as we found ways to drill longer laterals, to optimize the spacing of wells, to complete wells at lower cost with greater production coming out of them. So it's a series of things. In the deep water, we've simplified and standardized designs. And what used to take $30 a barrel or more in terms of cost of capital to go into a project now has been cut in half. And so it's not driven by AI yet. I do think over time we're going to see technologies like that continue this path that we're on.
We're going to get to that in just a second. If that's the case, if you can get more, even at a break-even cost that's a lot lower, why has the rig count gone down so much? Why aren't there more rigs coming online given the capacity here in the United States?
Because we can drill more feet per day with a rig today than we could in the past. And so rig count is not nearly as interesting a metric as how many feet a day you can drill, how many wells you can complete in a period of time. And so we're getting more work done out of fewer pieces of equipment today.
You talk about how AI isn't delivering those efficiencies yet, the indication being that maybe down the road it might be the case. Where specifically are you thinking? And I'm saying at a time when Chevron's cutting staff, so are other people. Is this a headcount issue? Is this something else? How are you seeing it being deployed?
Well, I think we're still in the very early days of applying AI at scale in our industry. One of the things that's undeniable about AI is it needs lots of data. A company like ours has as much data as just about any company in the world. And so we've got decades and decades of geologic data, seismic data, operating data, all of which can be used to feed these models to optimize operations, to improve our exploration success, to squeeze more production out of existing assets. And so we see huge opportunities to run our business with smarter technology, get better decisions made faster. And so there's certainly a cost dimension to this, but I think the real opportunity is going to be about the productivity of our assets and our business.
You announced this project, the first of its kind, to provide natural gas-fired power for data centers. Do you expect to do more of these projects? And what's the update on this one in West Texas?
Well, certainly the demand for power has been talked about now for the last year or so as the constraint in the growth of AI. Data centers and the ambition for data centers at a scale we've never seen before has become a commonplace. The reality is we need large-scale power. What we're working on is off-the-grid power because it's also becoming an issue with electricity prices, and we're seeing this show up in consumer sentiment, in elections. Our approach is to develop gigawatt-scale power generation, not through the grid, but dedicated to data centers. We've got a project in a couple of sites, actually, we're working on in West Texas, where we've got a lot of natural gas. We've got large gas turbines, the largest in the world, being delivered starting next year. And we're deep into discussions with multiple customers that would like to site data centers to use this power.
You're at the center of a lot of politically very important conversations, not just when it comes to AI, not just when it comes to Lukoil assets, also Venezuela, the only American company left. Can you give us an update on either conversations with the administration, your team on the ground? What is the future of Chevron in this country as the president says maybe he's going to send troops there?
Yeah, I don't know what the president's intentions are. We've been in Venezuela for the last 100 years. Our presence there, we believe, is important for the local economy, the regional economy, the people of Venezuela. The Venezuelan oil is sought after by U.S. refiners, and we operate there in full compliance with all U.S. law and sanctions. We're in discussions with the administration to ensure that we stay in compliance, that they understand the value that our presence brings to America. And so, that's...
And you plan on being there for the long term?
Venezuela actually has more oil and gas resource than Saudi Arabia. It's right here in our hemisphere, very close to the Gulf Coast refining complex. And we've been there through ups and downs. And like many places in the world, we have to take a long view on our presence in countries like this.
You talked about succession yesterday at this conference. How are you thinking about that as you talk to the board? Is there something you want to get done before you hand over the reins?
Well, succession discussions begin on day one, I think, for most CEOs. It's part of a board's responsibility to be thinking about the next generation of leadership. I have a long list of things, some of which have been accomplished. I mentioned the Hess transaction, which was a big one for us earlier this year. We have laid out a plan for the next several years to investors last month that grows free cash flow, that drives significant return of cash to shareholders. All of those are things that I want to make progress on. But when the time is right for someone to follow me in this job, the board will make that determination, and I will happily hand over to the next person.
Will you go right for landman?
Just 30 seconds left. Do you think that in 10 years, gas or oil is going to be more valuable?
Well, on an energy content basis, oil's got about 6 times more energy content per unit of volume than gas does. And so, they trade in sympathy with one another because energy is somewhat fungible. I think both of those commodities are going to be essential to the global economy. I think demand for both of those will be much higher than it is today. And I think you're going to see good companies in our industry still producing more of that and doing it in a way that keeps costs very affordable for the economy.
Mike Wirth, wonderful to see you. Thank you so much for being with us here this morning. Mike Wirth, the CEO of Chevron, as we look to the question around powering AI. Coming up, plus Tiffany Wilding of Pimco and Robert Tipp of PGIM Fixed Income with the latest Fed interest rate decision on deck. This is Bloomberg Surveillance. stocks dipping just a little bit ahead of that Fed meeting as people wonder exactly how much the Fed can come out with any kind of signal, let alone a dovish one, given the potential change in leadership. S&P futures, though, turning upward as the session grows older, up about 0.1%. This is a reversal from earlier, where it had been down as much as 0.1%. You can see NASDAQ futures also essentially flat, clawing back about 0.25% losses. Same kind of story on the Russell 2000. In the bond space, 2s, 10s, and 30s. A real question here about how much you get that sell-off with yields rising. Right now, just crossing, we get the employment cost index with the latest read on wage inflation. Bloomberg's Michael McKee joins us now with more. Mike, what does this data from the third quarter tell us?
Well, it tells the Fed that the labor market was a little bit looser maybe in the third quarter because we didn't see a big rise in wages and salaries. It comes down from what we had seen in the second quarter. The overall ECI comes in up 0.8%. The forecast was for 0.9, the same as in the second quarter. Wages and salaries were up 0.8%. They were up a full percentage point in the second quarter, and benefit costs increased 0.8%. That was a slight rise from 0.7 in the second quarter. A little bit less meaning to it because we don't have the other labor data, like how many people have jobs or have been getting jobs. But it does give the Fed a bit of a read on inflation, and it's not bad news.
Mike, how much are we expecting to sense at this meeting later today? We're looking at data like the ECI. We're looking at JOLTS data where you could have a choose-your-own-adventure kind of interpretation. And then we could potentially get even as many as 4 dissents in both directions this afternoon.
Well, it's going to be a very interesting meeting, perhaps, Lisa, the most interesting meeting that we have had in years and years. Markets are pricing, of course, the idea of a hawkish 25 basis point cut with those multiple dissents expected on both sides, some thinking we should cut more, some thinking they shouldn't cut at all. We'll get the dot drama of who thinks or how many think they're going to cut how many times in 2026 and their unemployment and inflation outlooks for the coming year. But as you mentioned, it's the dissents that will get a lot of attention, both in the dot plot, because how many people thought they perhaps shouldn't have cut rates at this meeting. We haven't had 3 dissents since 2019. We haven't had 4 since October of 1992. Now, if you want to go beyond that, 5 dissents, wouldn't that be fun? 1983 was the last time we saw it. We haven't had 3 governors dissent since June of 1988, so we'll see what Bowman and Waller and Myron do. If they all dissent, then that breaks somewhat continuing record. So we will be watching closely to see what they do, and we'll have all that for you at 2 p.m. and 2:30 with the Chairman's news conference.
Yeah, the Fed party like it's 1988. Michael McKee, thank you so much. Let's stick with the Fed. Tiffany Wilding of Pimco writing, we expect the Fed to deliver another 25 basis point cut while at the same time signaling that it's likely to start 2026 with rates back on hold. Tiffany joins us now. Tiffany, great to have you. Thank you so much for being with us. So you think a hawkish cut is what's on deck later today?
Yeah, absolutely. And thanks for having me. Yeah, so we ultimately think they will cut at this meeting, but all of the other information that we're going to get will probably have a hawkish shift. So we think there's a pretty good chance that the 2026 median dot shifts up from implying an additional cut in 2026 to being on hold. We also think Chair Powell will be having to explain at the press conference that this is the last cut for a little while. We ultimately think the Fed is likely to be on hold throughout his term, and you could also see some hawkish shifts in the statement. Really sort of underscoring that additional cuts from here will be dependent on downside risks that we've been talking about in the labor market actually being realized.
How much does it matter if he indicates that he is going to hold rates tight, given the fact that he's probably not going to be on the Fed after the first couple of months of next year? In other words, is he just a lame duck, or does he have more clout on the committee than some people are giving credence to?
Well, I mean, ultimately, he has not signaled that he's going to step down. So there's a very good chance, although, the precedent has been that chairs, when their chair term ends, they do ultimately step down from their governor roles as well. But it does seem like there's more question around if Powell will do that. If he does stay on, then he will have a say. He'll continue to be a voting member on the FOMC as long as he's there. Ultimately, the markets have already priced priced out. I think the next additional cut is more fully priced into markets in June. So that markets have kind of reflected this idea that we're probably going to be on hold for the remainder of the year.
Do you think he hasn't?
For the remainder of his term.
Do you think he hasn't signaled yet, to your point, whether or not he's going to step down as a governor, although it would be very odd if he didn't leave the Federal Reserve when his chairmanship is up. Do you think for him it really is highly dependent on who the president picks?
Yeah, I mean, Powell. It will be obviously it will be a little bit unprecedented for him to stay on. I think Michael Barr is another one that is also a question of if they'll step down, and we haven't heard anything from him on this. Yeah, and I mean, I do think that both of those folks and everyone at the Federal Reserve is very committed to the independence of the institution. And I think their commitment to that, could drive them to stay a little longer. But, of course, we'll have to see.
When it comes to Fed independence, the president yesterday was talking about how these governors appointed under the Biden administration were done via the auto pen. He wants the Treasury Secretary to look into it. A lot of people don't think this is going anywhere because of a lot of legal challenges. These individuals were Senate confirmed. But do you think at some point the market will maybe test and this concern about Fed independence?
Yeah, well, I mean, this has been a major a point of issue, and I think the fact that we're even talking about it, is maybe somewhat concerning in terms of the broader market discussion. But I think there are several points next year where that discussion could certainly come to the forefront. Now we'll have, I guess, in January the president will announce who he is picking for the Myron opening. And we think ultimately that will probably be who he wants as the next chair. But then after that, we'll also have the Lisa Cook case that is also being heard early next year. And the merits of that case are likely to be announced later in the year, possibly in June. So that will be another point that the markets will have to contend with this question on how many personnel, how many new governors ultimately Trump will have to put on the FOMC. And there is a scenario out there where he has a significant amount of governors that he can appoint, which can shift the view or the bias of the committee in a more dovish way. Of course, we'll have to see what happens, but it's certainly a risk.
Tiffany, it seems like a lot of people in the markets believe that actually the Fed does have room to cut a significant amount more, in addition to the 175 basis points of rate cuts that we've gotten since September, if the Fed does indicate that they are going to lower by another 25 basis points today. Why do you disagree with that, given the fact that we have seen some potential hiccups in the labor market and real concerns, certainly in sentiment surveys among consumers?
Yeah, well, I mean, we're much clearer, we're much closer to neutral now than we were, even back in June, right? With today's rate cut, we'll be 75 basis points closer. I think the median FOMC official puts the neutral interest rate at around 3% right now, so we're very close to that. On the other side of that, though, you do still have inflation that's running above target. 3% is where we think that it'll end the year this year. Growth has been much more resilient than expected in 2025. You have consumption that has been much more resilient than expected in 2025, despite the labor market weakness. And that growth resilience of 2025 is what's coming into the year where we're also expected to get more fiscal easing. So the One Big Beautiful Bill Act that was passed last year included some pretty decent sized fiscal easing and supports that offset the tariffs in the first half of this year. So consumers and households will get pretty big tax refunds. So we think there's certainly a risk here that you could see inflation that's a bit more sticky and takes a bit, is further delayed in making progress towards target. And the prudent thing to do in that scenario, is to continue to wait because you've already cut rates closer to neutral. But taking a step back from all of that, we would agree that there is more room to cut interest rates versus neutral here. It's kind of more just a matter of time and risk management in terms of the Fed outlook.
Tiffany Wilding of Pimco, thank you so much for being with us this morning. Turning now to bonds. Bond yields sniffing out something. Global yields rising to levels not seen since 2009. Robert Tipp, head of global bonds at PGIM, writing, a disappointment trade is unfolding across several developed markets as investors come to grips with central bank rate cutting cycles that may be ending soon. Robert joins us now. Robert, thank you so much for being with us. What exactly do you think is behind what is going on in long bonds globally, not just here in the United States?
Right. Well, there's quite a bit of focus among bond market investors on the JGB market, right? Japan, after achieving their inflation more than achieving their inflation target now for some time, has been hiking interest rates, and you've had a tremendous bear steepening of their curve with their yields pushing up and into European bond yield levels. And so the bottom of the envelope of what people saw as reasonable DM yields and the lower end in extremis has been pushed up. At the same time, central bank easing cycles have ended and raised the question of, is the next move a hike? And this has happened in a number of places around the world, whether you're looking at Europe, whether you're looking at Australia, New Zealand, Canada, where all of a sudden after these eases, you get a delayed reaction in the economy, and all of a sudden the markets have to think about, wow, where should the 10-year be if the next move is going to be a hike? And so I think that's been an element in the recent sell-off in treasuries.
Do you think, Robert, that there is anything that the Federal Reserve can do to lower 10-year yields if this is a global phenomenon, even with the use of balance sheet, even with potentially an additional 100 basis points of rate cuts over the next 16 months?
Right. Well, I think that the Fed wants to have a balanced outcome here. They want to have inflation come down to target, and they want the economy to keep expanding. And when you look at what the Fed's guidance has been for the last 2 years, it's been that a couple years out, they were going to get towards a 3% Fed funds rate. And as they did that, the yield curve would achieve a slope of about 100 basis points, and the 10-year would be around 4%. And honestly, I don't think there's going to be a lot of change from that. In your coverage of the ECI, here we've seen this in the other BLS statistics as well. Wage growth is very moderate. That is an ultimate driver of service inflation. So there is reason for the Fed to look at the slowly rising unemployment rate, see that building slack, have some optimism that inflation is not going to spiral out of control and ease. And I think one of the things that could curtail or not, depending on how things go today, some of this increase in rates is where we see the dot go for next year. Right now, there's a 3.6 and done kind of cluster of dots there for next year. And I think you're going to see that tick down. I think some of the longer term dots you may see move up towards that level. But I think creating some optimism that rates are still headed down towards 3% in a soft landing, successful scenario may help to cap yields here.
If you do get a really dovish Fed that comes out, even Fed Chair Jay Powell indicates that there is more rate cutting ahead, and you do see that long-term dot not move up, but actually stay lower and continue to go down. Does that make you more bearish on long-term bonds? Does that make you concerned about the investment prospect longer term?
Yeah, well, I think the front end of the curve is an important anchor. And if you get a massive drop in the front end of the curve, it's going to be very difficult for the $8 trillion in money funds to sit there earning much less than treasuries and say that they're going to have a buyer's strike. So I don't know that that would push yields up. But in terms of a dovish outlook for today, I think one of the things that the potential nominee Hassett has indicated is forward guidance is kind of dead. You know, once you're not at zero and you know you're going to be there for 5 years, you're up, you're at 3.9%, you can't tell people what you're going to do. So I think they're going to leave it open-ended today. But the fact of the matter is the economy is decelerating. They have optimism that inflation is decelerating. And I think that, you know, somewhere within, you know, a quarter point of where we are here, you're going to see a cresting of yields on that kind of optimism.
Robert Tipp of PGIM, thank you so much for being with us this morning ahead of the Fed. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. New data from Pfizer is suggesting a potential change in the future of breast cancer treatment. A study revealing that adding Pfizer's Piegza medicine to initial therapy treatment delayed tumor progression by over 8 months. Researchers say the findings support giving the drug earlier, potentially prolonging the time until the disease progresses. Meanwhile, JP Morgan announcing it expects to spend $105 billion next year, higher than the top estimate from analysts surveyed by Bloomberg. The consumer and community bank is a big driver of the expense growth due to higher compensation for advisors, product marketing, building branches, and investing in AI. And Oaktree Capital co-founder Howard Marks says AI has created a terrifying outlook for employment. He warns that the assumed productivity boom from AI fails to consider how many people will actually be able to afford the additional goods produced. Tune in tomorrow at 8:45 a.m. Eastern for Lisa's interview with Howard Marks. That's your Bloomberg Brief, Lisa.
Thank you so much, Yahira. Up next, Bloomberg's Ed Ludlow, breaking down the latest reports surrounding DeepSeek's usage of NVIDIA chips as we wonder the national security aspect, the issue between China and the U.S. and trade relations, and then the ongoing desire for the likes of NVIDIA and AMD to get a full footprint in the international chip sales space. From New York, this is Bloomberg.
We have to step back and understand something, that bond market cycles are very long-legged things, and the 40-year bond bull market ended at the pandemic lows in 2020. If you think about it, it's almost remarkable that the confluence of the U.S. being the premier destination for capital has actually caused spreads against global bond markets to compress.
That was Julian Emanuel of Evercore ISI on the surge in global yields ahead of today's Fed rate decision, making the argument that, if anything, U.S. rates are relatively low compared to the global bond yield sell-off. And indeed, if you take a look at bond yields right now, they are below where they were to start the year at 4.6%. Right now we're at 4.2%. So yes, still it is up from the recent lows, but down from the start of the year across the board, 2s, 10s, and 30s. You are seeing a little bit of a sell-off, but nothing very dramatic. Counting down to the opening bell, here's a trading diary for the week ahead. 2 p.m. Eastern, the FOMC rate decision, followed by Fed Chair Jay Powell's press conference at 2:30, plus earnings from Oracle after the closing bell, a real question around the indebtedness of that company. And plus Thursday, another round of jobless claims, as well as earnings from Broadcom and Costco. Friday, we get Fed speak again from Presidents Anna Paulson, Beth Hammack, and Austin Goolsbee. Turning back to a developing story, the information reporting earlier today that Chinese AI startup DeepSeek used NVIDIA's top-of-the-line Blackwell chips to develop an upcoming AI model. Sources saying that the chips were smuggled into China via other countries permitting their sale. Bloomberg's Ed Ludlow joins us now from San Francisco. Ed, thank you so much for being with us. This is something a lot of people suspected, that DeepSeek couldn't have done this without access to some of the highest tech chips. How does this change the landscape in terms of what people understand about the efficiency and some of the gains that we've seen in Chinese AI technology?
Well, it changes the landscape, for one, because it's currently illegal and prohibited for the Blackwell technology to be exported to China. Again, this is the information's reporting, and Bloomberg has not verified the reporting. But what the information report sets out is that DeepSeek acquired the chips at a point of origin, a country where they are permitted and were already installed in data centers where they were authorized. Those servers were dismantled and the chips were smuggled into China, according to the information's report, even passing inspections by server companies that are authorized to do business. So there is some disconnect there. And again, in the information report, DeepSeek has not commented, NVIDIA has not commented, Bloomberg has not spoken to either of the parties. There's a line in the information report which I want to flag very clearly. The information are reporting that DeepSeek would use thousands of the Blackwell chips to train a major model that is not yet released. Now, the reason that's important is that when you speak to anyone in industry, even with Blackwell, the absolute cutting edge at this moment in time, if you're going to train a major model, you don't need thousands of Blackwells. You need hundreds of thousands of Blackwells. And bearing in mind that NVIDIA will ship millions of units of them this year, but is still supply constrained to an extent, the question will be, well, hold on, how do hundreds of thousands of Blackwells go missing or unaccounted for? And is the information right here that it's thousands? Because,
and also which countries potentially we are seeing some of this leaky tech. Ed, also, can you give us an update on what's going on with the H200? It seems that there are Chinese firms who are interested and want to buy them.
Yeah, so as I understand it, according to one source, the president was given a range of options, right? Export zero, no tech because of national security risk. Export all the tech, the absolute latest, flood the Chinese market, cut off Huawei, the oxygen to Huawei. They decided to go with H200 for a very interesting reason. As part of the analysis, the White House team looked at what Huawei can currently do. And they basically said, okay, Huawei has a 910C chip that chip for chip is not as good as H200, not as good as Blackwell. But what China and Huawei have been able to do is take that specific chip and in the form of a rack or a cluster at scale, lots of chips in aggregate, get performance out of its Cloud Matrix 384 system that it is comparable with Blackwell. So that's the narrative, right? They're exporting H200 to the Chinese market. It's 18 months behind the technology that American companies have access to. Blackwell is what we're talking about. But noting that the real concern is that actually China's found a way to get performance out of technology that is generations behind at the chip-for-chip level.
Ed Ludlow of Bloomberg, thank you so much for being with us. We look forward to hearing all of Ed's reporting. He did have this incredible scoop about SpaceX potentially having an IPO of $30 billion next year, one of the biggest ever. Really interesting at this moment.
Yeah, mid to late 2026. So this is going to be a massive story for Elon Musk and those investors that are into SpaceX for next year, and Ed Ludlow leading the coverage there. That is going to be something, wow, because people kept thinking the timing would slip until 2027. Doesn't look like it.
This is the backdrop that we're looking at with a lot of enthusiasm around tech of all sorts, whether it's SpaceX, whether it's Oracle coming out after the opening, after the closing bell today. Coming up on the Fed special, which really is the marquee moment, 1:30 p.m. Eastern, Bob Michael of JP Morgan, Subhadra Rajappa of SocGen, Matt Lazzetti of Deutsche Bank, and Stephanie Roth of Wolfe Research. The expectation is that we are going to get a 25 basis point rate cut. That leads to 175 basis points of cuts since September of 2024. It has been a real easing cycle that has come on in a stealth mode, with a lot of people sort of suggesting that policy was still tight.
And at the same time, when the Fed has not reached their inflation target, the bias right now is still to the labor market. The press conference is going to be so interesting because obviously on the other side of Washington, D.C., there might be interviews taking place for who's going to be the next Fed chair. And how many dissents do we get at this meeting? And what is Jay Powell going to say about it?
Yeah, and does it matter? Can he wrangle together a committee that is incredibly divided, potentially the most divided, going back to the 1980s? Coming up tomorrow, Dan Skelly of Morgan Stanley will be joining us, Libby Cantrell of Pimco, Kristen Bitterly of Citigroup, and don't miss this, Oaktree co-founder and co-chairman Howard Marks, after a memo where he talked about the possible concern around job losses tied to AI, plus questions around a tech bubble. This was Bloomberg Surveillance. Good morning.